Up only.
10, 9, ignition sequence start. 6, 5, 4, 3, 2, 1, 0. All engine running. Liftoff. We have a liftoff.
Up only.
Hello and welcome to Up Only TV. I'm Ledger. We've got Haseeb on the way and Cobie, of course. Before we get to it, let me tell you about our partners at FTX. Go to uponly.tv/FTX. Do it right now if you've never done it before. Go sign up, swap directly from one asset to the other. Of course, you can track your portfolio like you've known and loved since 2014 with zero trade fees. Earn interest, earn yield on your tokens. You can do it with FTX. You can get 8% up to $10,000 and 5% beyond $10,000 right there on the FTX app. Get it from your favorite app store, uponly.tv/FTX. Cobie, what's up?
Do you sometimes do that advert in your daily life? Like you got it down now. You say exactly the same thing every time, almost like it's pre-recorded, but there's enough slight mistakes in it that it's not pre-recorded. And I can imagine just someone saw you in real life and was like, "Wait, I think that might be Ledger Status from Up Only TV," and you turn around and go, FTX, know your portfolios you know and love since 2014.
I'm a person who appreciates routine, so I don't know.
Yeah.
Like I'm actually really, really bad at memorizing, so it's definitely not memorized, but it is like quasi recited. You know, like one day I'll come on, probably next week. Now that you've given me such praise, and I'll just completely forget it. I'll be like, "What is the name of this company that is our sponsor?"
Oh, I thought you nailed it, and I think our overlords at FTX would be very proud of you.
Oh, thank you. We're very appreciative to our overlords, all the CEOs of all the FTXs. I saw there's like a new FTX in the Bahamas, and it's like digital something or another. I don't even know what that is, but it's FTX, so, you know, good for them.
Yeah, there's a picture of Sam doing a power stance. Did you see it?
My
He was doing the
God.
X with his legs.
Power posing.
It was so good. It was like I don't even know what you call that stance. It was definitely a power move.
Yeah. Haseeb, welcome to the show. Thank you for joining us. How are you doing today?
I'm doing well. Thank you for having me, you guys.
So for anyone that like we've got a bunch of audio listeners who tune in, and sometimes they send us comments like, "It took 35 minutes for me to know who the guest was because you forget to introduce it every time."
Let's keep them in suspense, actually. Let's keep them in suspense.
Yeah.
I feel like we should just go. No, it's fine.
Can you give a little background on who you are, what you do, how you've ended up on this miserable podcast?
Yeah, absolutely. So my background, very briefly. So before I ever got into crypto or tech, I used to be a professional poker player. Did that for about 5 years, from I was 16 till I was 21. Eventually, I got into the tech industry, learned how to code, moved to Silicon Valley, became a software engineer at Airbnb, and that's where I was when I caught the crypto bug. So I ended up coming full-time into the space in 2017, did some security research, actually initially discovered a front-running vulnerability against Bancor, back when Bancor was like the first real DeFi protocol in Ethereum, back in late 2017. Then I worked a little while at 21, which became Earn.com, which got acquired by Coinbase. Then I was working on my own stablecoin startup. Then I came onto the investing side. So I got my start at Metastable Capital, which is Naval Ravikant's crypto fund, which was founded in 2014, one of the oldest funds in crypto. Invested early in a bunch of stuff, and then I ended up coming into Dragonfly and really building out the firm of what it is today. So Dragonfly, you see, pulled it up right there. We're global from day one. We're a global crypto firm. We have folks both in Asia and in the US, and kind of cover everything, whether it be infrastructure companies, CeFi, DeFi, layer 1, layer 2, NFTs. We do everything. We've been early investors in a ton of stuff. As you can see there, we're seed investors in 1inch, early in Avalanche, Amber, which is one of the unicorns coming out of Asia, Anchor Protocol, Banky, which is also an Avalanche. I heard you guys have been doing some Avalanche mining.
Well, that's just me. I don't know about Cobie.
That's just you.
Yeah.
Okay.
Yeah, so Avalanche come up and like Ledger's euphoric. I finally get to talk about Avalanche.
Right.
I think my face is off screen right now. It's just ear to ear, you know.
Yeah, we were also early investors in Compound. I know you guys had Robert on recently. We invest in their Series A. Anyway, we are early investors in a bunch of stuff: DeFi, CeFi, layer 1s, layer 2s, whatever. We cover everything, and that's what we do.
Ledger, can you pull it back up? I've got a question for you, Ledger.
Yeah.
I got 3 questions for you.
Okay.
You've got to guess Which one? Nervos. What does Nervos do, Ledger? You got to make your best guess.
Nervos is putting gaseous products on the blockchain. Keeping track of inventory.
Would you mean like nerve gas?
Yeah, I don't know if you like tokenized parts or even something else. Oh, I see.
They're putting weapons of mass destruction on the blockchain so that you know where they are at all times.
Was that close? How close was it? Was that good?
It was not close. It was
not close.
Cobie,
Right,
what do you
another
think?
go, Ledger.
Wait, Cobie, do you know what Nervos is?
No.
That's brutal. It's only on page 2. It's not even that far down CoinMarketCap, guys.
Ledger, you get another go. What's Skolem Labs?
Skolem Labs is actually a tobacco company's pivot to blockchain. They used to do a popular Southern tobacco dip, if you know what that is, and now they've.
Is there something called Skolem that I don't know anything about?
That?
Yeah, and now it's transitioned into putting blockchain in their name so that their stock will perform positively.
Wait, blockchain's not in their name though. That's the problem.
It's Skolem Labs blockchain in parentheses.
I'm guessing that's also wrong.
You know, that's the closest one so far, but it's still
All right,
wrong.
you get one more go, Ledger. Scroll up a bit.
Okay.
What is Nuo? What's Nuo doing?
Nuo stands for New Age.
That's a U, not an A.
Yep, it stands for. They need to work on their brand.
New Age in German. You have the umlaut.
Yeah,
in
it's German for New Age exploration. It's actually, it's putting the ledger in space. So they're satelliting the blockchain to compete with.
All of your
blockchain.com.
guesses are very 2017.
Yeah.
Sorry, that's where my head is today.
Was that right?
Why don't I go in and tell you what they really do? So Nervos is a layer 1 blockchain. Nervos is a layer 1 blockchain that's the founding team is based in Asia, and the whole thing is built on RISC-V as a VM, and it's a proof of work chain. So that's Nervos. The second one was Skolem Labs. They basically give access to DeFi for centralized players. So if you're like a bank or you're like a trading firm and you can't touch DeFi for compliance reasons, you can use Skolem. And they make everything super easy, and they do trade accounting and everything. And then Nuo, this one's actually kind of a deep cut, so they're not called Nuo anymore. But Nuo was one of the very first lending protocols on Ethereum. They ended up eventually shutting down, so they were very similar to Compound. But they still exist. But the main product now that the company builds, so I think their TVL must be tiny now. I don't even know what's going on anymore, but it's basically not actively developed. At the time, it was really close race between them and Compound in the very early days.
Wow.
But it's an Indian team. They ended up moving instead to building a neobank, which is called On Juno, and that's what they do. So there you go. Oh, you can pull up their website.
I feel like the description here is pretty close to what my guess for Nuo was.
That is true, actually, now that you mention it.
All right, enough about these projects that we don't know anything about. Well, one of us knows something about, the others don't. So when you, gave you a quick intro, you said you were a poker player, and my sort of crypto podcast guest bingo went off, because that is one of the, if you're gonna have someone on, you've got maybe a 1 in 3 chance at a poker player, professional poker player at some point in their life.
Although most of them are traders, and I'm not a trader, so that's the difference.
Yeah, that is true. That is also that is true, because they love that sort of risk gambling, mathematical stuff. Why do you think there is such a big poker to crypto movement, and is it were you on a mailing list, a poker mailing list, and they were have you heard of Mt. Gox?
I think it's actually here's what I think. There's a few reasons I think why crypto and poker have so much overlap. One of them I think is dispositional. A lot of the people who end up becoming professional poker players were people who kind of in their DNA, they're willing to do weird shit to make money that broader society doesn't really understand or put traditional prestige on.
Yep.
And that takes a certain kind of person. And that certain kind of person was, I think, naturally drawn to also something like crypto, even if they don't necessarily have the skills, right? The skills of poker and the skills of crypto are so different. Crypto requires a lot of technical know-how. Obviously, markets are different than poker. There's some overlap, but I think people tend to play it up more than it's real. Like because I know a ton of poker players, and a lot of them have tried to get into crypto, and most of them just lose money. Like the average poker player is actually not that much better than the average person just getting into crypto. Yeah, exactly. They just come in and gamble. They buy coins. They're like, why aren't I winning? Like they don't, they don't necessarily have the background knowledge that you need in order to be successful in crypto. But there are some people who end up being successful in crypto who also end up being successful in poker who also end up being successful in crypto. And I think another reason why that is that there's something around like the kind of one, they're both very male spaces, a lot of young men, I think, who end up succeeding primarily, in large part because it rewards being a little bit obsessive. So if you can like spend almost all of your time just like reading and learning and like getting in these weird kind of super nascent and kind of out there communities, then you can really develop an edge and kind of gain a foothold and start doing really well. Now, I'm more on the venture capital side. And investing in venture capital in crypto, there are actually very few people who I know who have poker backgrounds who've gotten into VC. There are a few of them, like Ascensive Capital. There are a few individuals who I know who've done poker, but very, very few professional poker players who've made their way into VC. Most of them end up in trading. And it's also in trading as well. It's kind of like VC is more of a team sport, whereas trading is like more of a solo thing. And poker is 100% solo activity. Yeah. Unlike most other sports, when you're playing poker, it's just you and yourself. Nobody's on your side. No one's rooting for you. Nobody's trying to help you win. It's like a war of all against all. And that very much is kind of how crypto is as well.
Our buddy Primo in the chat said the poker ban of 2011 also made it just a tactical thing, like getting payment out of crypto or out of poker stuff into real life, essentially forced a lot of websites into using crypto primarily, which was very early. So that maybe increased that percentage a little bit, but yeah. Yeah.
There's probably also a self-selecting bias on people who are comfortable, not having a safety net, right? Not having like a planner or something sustainable and something reliable. It's funny because like if you're a trader, there's like maybe 1 in 3 chance you're if you're a crypto trader, 1 in 3 chance you're a poker player. And if you're a crypto VC, there's a 1 in 3 chance you're a product manager at Coinbase, I think.
Is it really? No.
It's like a family tree almost out of Coinbase, it seems.
I feel like Linda and Nick Tomeno are the 2 ex-Coinbase product managers, but I don't think it's that many. But that being said, I think you raise a very good point, which is that like in poker, so it's certainly true that like poker, traditionally, like poker was very underbanked / unbanked after a certain point. After 2011, poker basically became unbanked effectively. And so a lot of people had to use Bitcoin or other mechanisms in order to actually settle up and continue gambling. But a lot of the reason why a lot of poker players have transitioned over is also because poker has been getting worse as an economy. Poker is the definition of a zero-sum game in that some people are winning money, some people are losing money. Technically, it's a negative-sum game because the house is taking a rake. So everyone's losing money slowly over time, but some people are losing more money and giving it to other people who are making money. And back when I started playing poker, so I started playing poker in 2006, and online poker at that time was very, very juicy because there were just a lot of amateurs and like, kind of just dentists who were out playing, gambling online. It was kind of fun and everything was very splashy, and there weren't that many professionals playing at that time. And over time, it's become more and more professionalized, and the edges have gotten smaller and smaller, which also means that bad players lose money a lot faster. And it's just not fun. Right? It's not fun to sit around a table with like 5 super tight players who are all playing like perfectly optimal, and you're just slowly draining money to them. Like that's not what people play poker for.
Yeah.
So that has kind of led to this sort of overgrazing phenomenon where poker games just get worse and worse. Fewer and fewer professionals can actually make a living, and they have to go elsewhere. Like you said, they have no safety net. A lot of them don't really have other skills.
Why do people always use dentists as the example of like dumb money?
I think because it's the most honest living you could possibly make. I feel like when I meet dentists, I always ask them, like, what made you decide to become a dentist? Like, where did you get your love for dentistry? And the answer almost always like, well, it's just, it's an honest living. It's like, wow, I would never be able to understand somebody who goes into dentistry. Maybe I just haven't been a dentist. But.
Well, I mean, I think the earning potential is pretty good, but it also requires an incredibly like broad array of skills. Like you're good as like a practitioner of dentistry, but also you have to be a pretty good business owner. You have to go to school for like 8 years and be book smart. be like tactically capable to use your hands and like drill into someone's skull or whatever they do. Like there's a lot that you have to do to be a dentist, and then they make pretty good income. I feel like the biggest appeal is most of them don't work on Fridays, so it's like I play golf on Friday or like whatever. Yeah, like that's a big. I feel like it's a kind of a lifestyle thing where you make pretty good money. You don't work on Fridays, and you put in like 8 years of prep, and then like you run your little family practice, and off you go. This is
your description of how poker got less fun, and the people just like slowly losing money and bleeding out over time, sort of feels a little bit like what day trading Bitcoin it is like more and more, because 2013 it felt like relatively easy, always did what you thought it would do, and now it just all get bleeding money to like 3 Arrows and Alameda over time. Just like they're just slowly extracting it all.
I wrote a tweet about this a little while ago that like every generation of young people, there's some hustle where if you get in really early and you're willing to look weird and like kind of piss off your parents, you can make a lot of money exploiting edges really, really early in a space where institutional players don't really understand, right? So in my day, it was poker. For people born like 5 years later, it was like fantasy sports. Eventually it became, crypto trading. Then it became ICO flipping. Now it's JPEG trading. And pretty soon JPEGs are going to go the way of all these other phenomena, and it'll be harder for, 17-year-olds to make money doing it. But there will be a next thing that's going to be so weird that you and I are going to be like, wow, all these young kids, I can't believe they're doing all this stuff. It's crazy. But it's going to be the new way to mint millionaires.
I do think.
Why do you think that is? Because it's quite interesting, right? Because I spoke to Suzu about this a bunch, and I described it as like every generation builds its own Ponzi and opts out of the previous generation's Ponzi. And the way it is most evident is like gold is just a thing you find in the ground that everyone went, yeah, that's rare. That's right. That is really valuable, isn't it? That's like worth trillions. Like I've got a little bit of it. And then the new generation like comes along, goes, it's like a rock. Like, are you joking? Yeah. What we think is rare are crypto punks, like these fucking really tiny images. That's worth way more than gold to us. And they just opt out of the previous Ponzi and create this new one. Do you think this is just continues throughout history, and like in another 100 or 150 years we create a new Ponzi, or like, is the crypto revolution? This time it's different. It's the backbone of the like financial industry forever.
That's a tricky question. I think it's certainly true that new generations create new things that value over time. There's actually a line I really like by oh shoot, I'm forgetting his name. The guy who wrote the Institutional Investor's Guide to Cryptocurrencies. What's his name? Do you know what I'm talking about?
I don't remember. I don't read. Okay. I can't read.
Well, that will make it tough for you to really follow his work. But I'm forgetting his name. But he's this guy I think he was KKR.
I'm on my way. I'm just trying to find his name. Backstop Solutions.
Yeah. Institutional Investor's Guide to Crypto Assets. That's the name of the thing. It was very widely circulated back in 2017. But he had this line that I really liked, which is that, I can believe that through crypto, we found ways to create new things that are valuable, but I don't believe we found a new way for things to be valuable. John Pfeffer, that's his name. And I largely agree with that. I think that most of the time when you cannot articulate why something is valuable, you don't understand it well enough, or it's just a Ponzi, right? Or it's just got some other underlying bullshit mechanic underlying it. But I think for most of the things in crypto, we actually can't articulate why it's valuable. I just think people are generally pretty bad at it. And that is what I look for, especially, being a VC, you see a lot of stuff that's like, okay, what the fuck? Like, why would anybody want that? And if you can't answer that, usually it's a sign you don't understand it and you probably shouldn't invest. But a big part of, even crypto funds, right? Like, you look at a crypto fund, they're like, okay, how is this not just a Ponzi? You create 10,000 of them, they're all kind of ugly. Like, a 12-year-old with like MS Paint could have drawn these. Why are these so valuable? And if you try to come up with some argument of like, well, it's like it's super valuable, whatever. There are only 10,000 of them, right? If the answer arrives at there are only 10,000 of them, then it feels like, okay, well, there's 10,000 of a lot of things, right? Clearly, that's not the reason why they're valuable. The reason why they're valuable is because there's a community of people who, all of whom we really care about, who also value these things, right? What else do we know that's like that? Well, one example is like a Rolex, right? Why are Rolexes valuable? Well, they're worth a lot more than just the value of the fucking metal that goes into creating a Rolex. The reason why Rolex is valuable is that you know a bunch of other people who value Rolex. Or maybe you don't, and there's some other brand of watch that you feel like actually is valued by the people you care about. CryptoPunks are valuable because the people who we care about, the people who are at the vanguard of this new generation of crypto talent and wealth, they value this. This is their way to flex. And whether it's buying a car, whether it's buying a watch, whether it's owning a Rembrandt, these are all different ways to flex. And the internet has never really had a very native way to flex, right? If you think about it, if you want to show that you own these different, financial status symbols, the way you do that right now is you go on Instagram and you post a video of you next to your Tesla, right? That's how you do it. And it's just like very crude, the way that you can do it today. Why don't we have digital native ways to do something that is such a fundamental part of human nature, is buying things and showing your friends who you are based on your financial activity, right? Like, it's core to what we do as human beings, but there's been no way to express it natively on the internet until the advent of these kind of social artifact NFTs. That's what I think they are.
Do we think that these might be like mildly obscene though? Like, this is a $544,000 CryptoPunk, according to the asking price. Like, yeah. How do we differentiate between like, we decide this is valuable versus like, this has gone too far? Whereas a Rolex as a flex, I feel like it was a relatively static level of flex for a while. Am I getting that wrong? Or how do we differentiate between like the flex value versus bubble dynamics?
So here's the reason why a Rolex is a relatively static flex, is because Rolex, the company, keeps creating more Rolexes, right? If there were only 10,000 Rolexes, which to be clear, there are for very, very vintage Rolexes that are like one of one and like only one of them ever created. I guarantee you the person who owns that is probably like some oil tycoon in like Saudi Arabia or something, and it's worth like, $10 million or something like that, right? For that Rolex, that thing actually is a flex more similar to a CryptoPunk. And the reason why, like if you look at a CryptoKitty versus a CryptoPunk, like that's really the difference, right? CryptoKitty is more like a Rolex. There are always going to be more. And if you want to get I want to join the NFT world, you could grab a CryptoKitty and it's price is no object. Same with an Axie, right? If you want to make your profile an Axie, it's probably more relevant these days. It's cool. It's not crazy expensive for you to take an Axie and make it your Twitter profile. But if you want a CryptoPunk, then it's like, okay, you're competing with the Saudi princes. Or
I like
the equivalent of that in crypto.
I saw a tweet the other day and it said something like, I can flex by buying a Lamborghini and, having a nice house or something, but like 12 people saw my car in the last month and like I had 3 guests over to my house, whereas like 700,000 people visited my profile over the last 30 days. Sorry, whoever that tweet is, if I butchered it, I got it wrong. I saw it briefly, but I saw that and it made a lot of sense. Like digital flexing, flexing is like human nature. It's been done forever. People have made careers on it. People have augmented their careers through it. But it is also now primarily done or at least in terms of how many people see it, primarily done online, but there is no digital native way to do it. As you said, it's all like videos of the real world. And in some ways, I think having a Ether Rock or something stupid like a CryptoPunk is actually a way bigger flex than having a supercar, because you can't do no with it. It's just like a stupid, like the fact that it's stupid and shit makes it a bigger flex, because like I just don't care. I just don't care. It's not like, I think this car is sexy and cool. It's like, I don't care about that. Fuck it, who cares?
Did you purposefully say stupid? Did you purposefully say stupid just in front of CryptoPunk and not Ether Rocks? Like, so the Ether Rocks are not stupid, or were you saying they're all stupid?
I don't really know, because I don't often think about what I'm saying until afterwards. So I couldn't tell you.
Which flex would you rather carry for the next like 5 years?
Oh, Punk, easy. Yeah,
okay.
Easy.
What about compared to like a Dino Pal?
I think punks will always have some like kind of cultural, historic value or provenance or whatever, because it has sort of been selected, I guess, as the flagship of Ethereum culture now. And if everything goes to zero, like despite anything, I think they'll be memorable. So probably punks. I guess.
I made you fudge your own bag.
My Dino Pal's cute, mate. Yeah, that's going to zero, though, isn't it? That's going zero. What the fuck's the Dino DAO? I got baited on that one.
Well, some things you do for love, some things you do to make money.
Yeah. The good thing about NFTs is you don't mentally calculate them into your net worth. You just go, oh, it's fucking zero. And then sometimes you look and you got loads of bids and you're like, wait, what?
Yeah, very true. I can't tell you the amount of times I've gotten airdrop something and I'm just like, wait. This thing's worth $5,000? Where did that come from?
Yeah, it seems like
I get sent dog shit. I don't get that.
Is it bad that when you say the airdrop was worth $5,000, I'm kind of like, I've had better.
No, I know.
That's not even 2 ETH.
So I want to ask a bit about y'all's like process for the fund side of things. We love to learn this about guests. Like, do you come in when they're brand new? Do you come in like as kind of the second stage of capital? Do you have a preference for tokens, equity, like how all that kind of works together? Or is it just broad based on what teams and projects and ecosystems you like?
We are very broad based. So we're a multi-stage firm. So we invest at the very beginning, like pre-seed or seed. We also invest Series A, we even do Series B, and sometimes even beyond that. Tokens and equity, we do both. Like, honestly, our fund is pretty split down the middle between token investments and equity investments, right? So we've done deals like Anchorage or Bybit that are equity deals, and then we've done things that are pure token, like a Compound or a Avalanche or a Near protocol. So we're totally across the board.
What challenges do you think there are, or advantages do you think there are when it's tokens versus equity? Because one of the things that I think in my head is when you have tokens, like if you get liquidity, you're going to be tempted to take it, like and essentially get out too early. Imagine you did that in Solana or something, and you're like, yeah, we're up whatever X, we're going to sell our Solana at $5, and you weren't. Right. It wasn't like a force hold like it is when equity all the way to IPO or acquisition. So like, is that a hard balance for you, or do you have like, is one easier for you to value? Like, when is the appropriate time to exit, or like that? How do you look at all that? Having experience on both sides. Honestly,
it's very hard because on equity, it's kind of the decision is made for you. Like essentially, until the company is acquired or if it goes public, those are the only moments where you actually have liquidity. So, barring that, basically you're along for the ride, and that makes your job as a VC a lot simpler. If you're a VC and you're investing into true crypto assets, right? So you're investing into tokens, then, usually we have lockups. So it's not like, we're not investing in any of these fly-by-night things where tokens live and then we can go dump it. So we're long-term investors. So most of the time we have 2, 3, 4 year lockups on the things that we invest into. But for a lot of the stuff, like we're fully liquid, right? So a lot of stuff we invested in early on in our fund one, we have the complete ability to sell whenever we want. Most of the things we haven't sold at all. And, that has obviously done well because the crypto market's gone up. But for the most part, the way that we think about it is that, so I don't know how familiar you guys are with funds, but funds have their own underlying investors, generally called LPs.
Yeah.
So we have our own LPs and they expect us, like, they look at us as the crypto experts. They don't really know that much about crypto necessarily. So we sort of see it as our job to say, okay, when do we think this investment is mature enough to say, cool, we think it got there. It's the equivalent of like, a company that IPO'd and like kind of made it. Now it's time to lock it up, sell it and then give it back to our LPs. And, when you're in crypto, the assumption that we all have, because we're in this market, is that crypto goes up over time. Like, everything goes up over time. Obviously, real estate, stocks, everything goes up over time because the world keeps growing. But crypto in particular, we all feel like it's significantly undervalued. I think there's a lot more that's coming, and we understand enough, we can see far enough in the future to understand the technology that's going to arrive. And so your inclination might be, okay, well then why ever sell anything? Why not just hold it as long as you possibly can until your LPs absolutely demand to get a return to you? And the answer, of course, is that sometimes in crypto, things just grow really, really fast and then like kind of fill in the space, you know? So if you imagine, let's say, for example, that there's some protocol you invest in very, very early on, and you think, okay, I think someday this thing can be like a $5 billion protocol. And it launches, and then like within a month, it's a $3 billion protocol.
Yeah.
So one thing you could think is like, okay, well, clearly this thing is gonna, I thought it was gonna 20x after it launches, so I should wait until it's, 60 billion or something. Or you could look at that and say like, okay, well, if I still, my valuation of the market hasn't changed that much. This thing just got pulled its valuation way far ahead. So if I wait another 3 years and it becomes 5 billion in 3 years, it's actually not that amazing of an investment relative to what I think I could do with other capital that I can deploy. And that to us is a sign of like, okay, let's go ahead and monetize this thing. We've had a great outcome. Team's done really great. And then we can move on and find the next thing. That happens sometimes. But to be honest, most of the things that we hold in our portfolio, we're still holding today.
That makes sense. So that's kind of like you have like a valuation model for something. You think the market's gone a little bit too quick or like realize it much faster than you thought, but that does not therefore change your expectations on the actual outcome. So you're like,
it depends. Sometimes it does, right? Sometimes it does. Like Avalanche.
And how do you know, like, how do you identify whether, oh, actually, I think this changes everything. This is now a 60 billion versus it's still going to 5, but 5's the top.
Right. So generally speaking, when we think about particular investments, you're usually thinking about, you have some kind of model, right? That model might take as an input some absolute number of like, look, here's the value of all the accounts receivable that could potentially be tokenized and then brought in to make it out or something like that, right? Like that's one potential way you think about a market size. Another way to think about a market size is relative. So you could say this thing relative to Ethereum. Well, okay, if Ethereum goes up 10x, then now your price target has also gone up 10x, right? So for something like Avalanche, for example, we invested in the seed round of Avalanche back when I was at Metastable, and then we invested again in the Series A and in the most recent ecosystem round in Dragonfly. And in Avalanche, Avalanche is always on a relative basis to the entire universe of smart contracts. And earlier on, that was Ethereum, and Ethereum was worth, 90 billion or whatever, and now it's worth significantly more than that. And so that naturally we should increase your price target for everything in the space. You saw that with Solana, right? Solana is already like more than half of what Ethereum was at the bottom of the cycle. And the reason why Solana has gone up so much is out of some sense of like, look, if this thing could become the next Ethereum, then great, that's a really, really big pie, given how big Ethereum has become now. So the same thing is true when you're thinking about investments. It's always relative to whatever is the input into your price target.
I've noticed that this year, as we've gone through this market, my personal ability to say like, I'm interested in an XYZ project and where in the world do I sell it? I love looking at charts and, technical stuff, and I used to rely on it a lot more. What I tend to have relied on more recently is that relative value, like you said, like, well, if XYZ protocol is worth 10 billion, but ABC protocol I think is better and is worth 2, then it can still 5x. And that allows you to have like different targets. But one of the threats of that, isn't it, is if the XYZ protocol valuation is off kilter, then like you're resetting your target at the same time that like you should have kept the target because you were right. And the relative basis is what was wrong. Like how do you figure out when things are too saucy?
When things are too saucy.
XYZ like a random thing. Or are you saying Tezos?
It's XTZ.
That's XTZ. Yeah. XYZ is like that's like the universal crypto domain extension now, isn't it?
Yeah, there's no XYZ token yet?
Yeah.
Maybe someone hasn't scooped that up.
Yeah.
XYZ emails always go to the spam box.
Really? Uh-oh.
Is that right? That's rough.
I'll have to talk about that after the
show. So to answer your question about what do we do when relative valuations are too saucy, like at a certain point you just have to use your judgment. There's no quantitative way to look at a market and say, yeah, this whole area is inflated. I don't know, you have to do what they pay us the big bucks to do, which is like use your brain and like decide for yourself where you think the market ought to be and where you think things are inflated. A big part of that is incentives. right? So if you can see that there's a lot of yield farming, or there's a lot of Ponzi-nomics, there's a lot of like unsustainable growth or economics that's buoying a particular ecosystem, a lot of times the market is kind of too short term to really care that, okay, the market leader is clearly being buoyed up by unsustainable economics, it's probably going to collapse. This guy is being comped to that, even though they don't have this crazy model. You see this kind of thing all the time, where there's like sort of one hop chain of reasoning and not the ability for the market to like look a layer deeper. So you just have to use your brain and look through the underlying. The thing about crypto is that it's pretty clear to everybody who's full-time in crypto that markets are not efficient. And there's a lot of stuff that if you just kind of do the obvious thing, a lot of times you'll be right and you'll make money. And that's a lesson I've had to learn over and over and over again. You always think like, oh, this thing is obviously going to be priced in. Everyone should understand this. This seems really straightforward. And it's not. It's just absolutely not priced in. And then the thing hits and, you know, the price goes down, the price goes up. And the longer I've been in the space, the more I just have come to accept it. Markets aren't efficient. And just knowing even marginally more than the average trader at jump, you can make good decisions. And that's not that hard to do.
I think that is quite funny because often there's like a narrative which takes, 3 months to play out. Like, let's continue with your XYZ example, Ledger. And it's like XYZ has these things coming out, but then XYZ goes up 25% on the day. So everyone thinks they've missed it. Everyone's like, right, well, I can't buy XYZ now. I'm too late. And then over the following 3 months, XYZ goes up like 10,000% or something. But a lot of people, instead of going, well, this is the obvious trade, I'd like, yeah, I'm 25% late, but I'll just fucking get on with it anyway and like buy the winner. They start going, right, well, if this thing's going to go up, then like maybe things in the similar sort of bracket will go up. And then this one's too obvious, so I'll buy the third one down. And then they just buy a loser and they're like, didn't work out. This crypto is such a scam. Could have just bought. That's why you should have just bought Axes. Should have bought Axes at any point in the year. It just only fucking goes up. And everyone was like, what's the next Axes? It turns out it was still Axes. It was still Axes the whole time.
That is one of the big lessons, especially in venture. You see it in trading too, but in venture, it's very fucking noticeable, which is that winners keep winning. Just if there's one iron rule of investing, it's that winners keep winning.
Yeah, that makes sense. Does Dragonfly do any directional stuff? So, when you see something that gets has like Ponzi-nomics or something, but you don't own any of it to dump, do you take short positions on stuff? Do you do any directional trading? So in our venture fund, we only buy if we do buy tokens that are already live, we'll negotiate something directly with the DAO, or we'll do some kind of OT direction, such that we have a relationship with the founders. We have products. I can neither confirm nor deny, according to my chief compliance officer, whether we're doing other vehicles. So we don't know.
Yeah, it's impossible.
Blink twice. Oh, the webcam connection is too. I was gonna say blink twice if it's a yes, but we
can't tell if you're blinking or not.
You can't tell if I'm blinking.
No, your video's been ragged.
You look a little bit like a crypto punk.
That's unfortunate.
Yeah.
It's all right.
Your audio
Can I try
connection.
rejoining maybe?
You can, yeah, we love to do these just moments where Cobie and I reflect on what the guest has been saying. We've been having a lot recently. You're welcome to rejoin.
Okay, why don't I rejoin? Let me do that.
Okay, I'll talk to Cobie.
Cobie, wait, I'm going to be two of me again. Hold on, let me get into position.
Go into the.
Wait, I'm on the other side. That was fast.
Look, places. And look at that, your connection's massively improved.
Yeah, you've gone from CryptoPunk to Hashmask or Bored Ape or something. That was like a massive leap.
I feel like I'm one of those Solana apes now, like the super.
Oh, those are so clean, except for they put them in the weirdest clothes. It's like, here's your bucket hat and maid's dress, and you're eating a juice box.
Everyone in chat saying 4K. Much better.
There you go. Look, we only pay for the best bandwidth.
Yeah, Cobie was just moving into his solo position when he's a great story.
Please go ahead. Don't let me interrupt you.
The moment's over. It's okay. He came back really quick and clean. We're good. I have another relative valuation question, if you'll allow me. Another one that always interests me is the Uniswap type comparison, like Uni versus Sushi, where market size is in Uni's favor massively, and relative market cap, it's got that based on the market size. But if you actually look at current tokenomics, like who's feeding token value accrual back to stakers, like Sushi destroys them because Uni doesn't give token holders anything. So do you give any real weighting
unless you do a proposal? Then they give you loads of money.
Then they give you $20 million for being like a blog.
Unless you're a student group. If you're a student group, then you make a lot of money from Uniswap.
Yeah. But in terms of like pure revenue back to token holders, like kind of those types of tokenomics, do you have any theories on why the market rewards a Uniswap in size versus like a SushiSwap type of thing that's smaller but actively paying token holders?
Yeah, I mean, there's a simple answer, which is that markets are forward-looking. So people understand that, like, look, I'm holding Uni not for the revenue I'm going to make this year. Like, the revenue you make from Sushi this year is not that significant relative to the market cap of Sushi. People are pricing these things as though they're going to keep making revenue over time. So if the presumption is that Uniswap is going to be distributing that revenue for many, many years in the future, then who cares if revenue turns on, in December or in March next year or in whatever, right? Like, if you look at the price to earnings ratios for most of these assets, they're pretty high, such that an extra 6 months of not making revenue doesn't impact you that much. So that is my short answer for like why markets don't care that much about whether or not they're getting the distribution. But then second is that Uniswap's revenue presumably it doesn't have revenue yet, but if you assume that it will eventually have revenue accruing to token holders. Because of the fact that they are the market leader and because of the fact that they invented the damn thing, you're always going to apply some kind of premium to the fact that, look, there's going to be a V4 someday. And probably V4 is something that only Uniswap is going to come up with. And they're going to find some way to monetize it before anybody else does. So even if SushiSwap eventually catches up on the tech side, it's been very, very clear that Uniswap, absolutely world-class team at coming up with the next generation of how on-chain trading is going to work.
What ratio or like what factor or whatever multiplier do you offer for the regulatory landscape there to say like, I don't
between Uni and Sushi?
Yeah, like Sushi can YOLO a little more and Uni's like, much more clearly American based and a little tighter in terms of what they feel capable to do in a current regulatory environment. So like, you might say, okay, well, I don't think it's possible to feed revenue back to token holders for like 4 years at least or something. Do you put any kind of effect on the where an entity is based and like what their tone is for what they might be willing to do?
So we very much do. I haven't looked lately at the numbers between Sushi and Uni, so I'm like not equipped to give a particular number multiple. But to your point, 100%. Uniswap is in a more precarious situation because of the fact that they're not fully decentralized. The team has more control than does SushiSwap, and they're U.S. based. Like they're literally in New York, which, right in the SEC's backyard. Yeah. That being said, after Maki left Sushi, Maki was pseudonymous. Nobody else at Sushi is actually pseudonymous. So they do have. That being said, it's easier to argue in principle that Sushi. They are more decentralized. They've had token governance for a very long time, but the team, their team is, people know where they are. They know where they live. Like they can, if regulators are so inclined, they could also go after Sushi. So I don't think the delta is as big as it was before Maki moved on.
Yeah. I hadn't considered it that way.
What do you reckon Chef Nomi's up to these days? Do you reckon he's just chilling?
I don't know. I hear he's running a big exchange now.
What?
I'm kidding.
Yeah, he's done an NFT drop 3 times. I completely forgot the question I was going to ask, and it was like very important. Then we spoke about Uni and Sushi for so long. I'm going to try and take a moment to remember it. So if you've got something else to ask, Ledger, I'm going to go into my mind. I'll come back with
Can I
answer.
say something that will help jigger your memory?
Yeah.
That we can talk about?
Yeah.
What did we talk about before? I'm not even drinking this time. I'm just.
That's why you can't remember. You elevate when you've had a drink. You just elevate your thought process.
We were talking about when to sell things. We're talking about relative valuations. We're talking about Uniswap and valuation. Was it not Uniswap related?
No idea. I did have another question because you mentioned. I can't remember. I'll remember. I'll remember.
It's gonna be such a letdown when you finally remember it.
Yeah, I know, and then I'll just come up with a better question later about
cool.
some other part. Oh, this is what I wanted to ask.
This is way smarter than the question I was asking.
But you mentioned, your LPs can kind of like demand that you return something to them. What does that look like in practice? Because I know that's like hypothetical or theoretical or whatever, and probably not that practical. And LPs are often like a certain level, have like a certain level of sophistication and stuff, and they know not to dump the bottom. But what's it like in practice? Have you had experiences of it, or does it ever come into play?
I think you're look, I love our LPs, but most of them, like most investors, are very pro-cyclical. They invest when things are hot and they sell when things are looking bad, which is most people who are not professional investors in crypto have the worst instincts. Yep. And that's why people decide look, I'm just going to give it to a manager and that manager will figure it out, because most of the people who invest in us, they've probably done some crypto investing before, but on net, some people make money, some people lose money investing in crypto. You guys probably know, there's probably friends that you try to get into crypto investing and they actually lost money. I'm like, how the hell do you lose money in crypto?
I mean, that's us. I make losing money. That's
everyone
need.
Just balance out right. Show.
Yeah. So I mean, some of our investors are quite sophisticated, but as a fund, part of our job is providing our LPs a way to invest in crypto where they don't have to deal with any of the complexity. Right, they don't have to deal with tokens and staking and knowing when the market's hot and when it's not, and which of these projects are bullshit and which ones are not. So when we distribute, so people invest in our fund, we do the investing, and then later we give them money back, hopefully more than they gave us. When we distribute, we just distribute back cash. We don't give them comp tokens and say, hey, you can go figure out how to put this in Coinbase and decide when to sell it. So there are some funds that do that, but most funds in crypto just distribute cash because it's just a lot easier for the LPs, because they wanted a crypto fund because, look, I want to invest in crypto, but I don't have any idea how to handle the actual technical components of it.
Aren't some of these...
It is interesting that, sorry, Ledger, it is interesting that some funds have started to do that. They've handed the investment, liquid investment, back to the LP. And Ledger and I had a debate about it the other day. Well, not a debate. I spoke to him for 7 seconds. I try as soon as the call ends, I try and get off and not talk to him for the next one. I'm just kidding, mate. But we were talking about it the other day, and it's interesting because in some ways it's quite good, right? As an LP, you get to take control back of the investment. Maybe you don't want to sell at the same time the rest of the fund wants to sell, perhaps. But on the other hand, buying is part of the hard work. And selling is also part of the job, and it's hard to sell. And if you give it back to LP and then the market dumps and they sell the bottom and get a much worse exit than a professional might have done. So how do you feel about the idea of giving the liquid investment to the LP directly?
I mean, I think if your LPs are open to it, I think it's great. That being said, a lot of LPs are just not equipped for it. I know there are some funds that do that, and the advantage, of course, is that look, if you have done an absolutely stellar investment and you own a bunch of something, and then you have to sell all of it to go distribute it to your LPs, a lot of your LPs, if you invested in good stuff, a lot of them want to hold good stuff. They don't necessarily want to sell immediately.
They want to hold on to those winners.
Exactly, I want to hold on to the winners. So there's something that's nice about that. Now, if you have, so the term generally in investing is marketable securities, which basically means that, if let's say you invested in Coinbase pre-IPO. So we had a little bit of Coinbase through an acquisition company acquired by Coinbase. And if you hold some Coinbase stock, you can just give that to your LPs because it's a marketable security. They can go sell it on, NYSE or wherever it's listed, and it's all good. And you can, it fits perfectly into the way that LPs are set up to take investments. But is Bitcoin or Ether, Bitcoin and Ether are probably good enough at this point that you could run a fund and give your LPs back Bitcoin and Ether, and that's fine. But if let's say something that's not even supported on Coinbase, right? It's only on Binance. You have a USLP and they're just look, I don't know how to create a Binance account. Do I have to go and create my own wallet. I don't even know how to use a CLI. I have no idea how to do any of these things. Like there are a ton of foot guns that could make it really terrible. And if you have 30, 40 LPs who need your help handholding, at a certain point, like, look, guys, why don't I just do it for you? There's a natural economy of scale to it anyway.
I like the idea that there's some of these funds who are returning the token investment or whatever to LPs. It's just because they own 30% of the market cap, and it's like they can't sell. So it's like, look, it's a race to the bottom. Have fun.
That's right.
Like no liquidity. Like you send it to them. Look, we did you such a fucking great job. You're up 10x. But then one person sells. It's like 8x, 6x, 2x down.
So yeah, that's the other thing. A lot of it is also about fairness, right? If you have a very illiquid market, you probably would have, because when you return, so the way that a fund works, a venture fund at least, when you return capital to LPs, that's when you book carry, right? Carry is like the reward you get on the profits that you generated as a fund. So when you book carry, that is the most sensitive part of a fund. Your LPs really, really care exactly how you book carry, because that's what determines the split of profits between the managers and the investors. So if you book carry and you have some, let's say you invest in some NFTs, right? Which we don't invest in NFTs in a venture fund, but imagine you did, and you're like, great, these NFTs are worth $1 quadrillion, so we're going to book carry, and we now own $20 million worth of carry. Here's your NFT.
Yeah.
Right? And you're just like, wait, how do I sell? Wait, I'm going to go put this on the market, and I can't actually get the amount of money you say it's worth. Just because somebody put it in a bid? That's how you're going to value this? Or how are you valuing this thing and saying that it's worth this amount of money? So somebody who owns a ton of a very illiquid token, they would not be able to just distribute that as carry. It's only if it's very, very liquid.
For what you realize.
LPs would be willing to say cool, we'll let you book that as carry, right? So for example, I know that a lot of the people who invested early in Solana, I've heard from some LPs that they're dealing with getting big Solana distributions. And they're just like, how do I custody Solana? There's a pension or a very old school family office that's trying to figure out what the hell is Solana? How do I custody it? What do I do with this thing? Because they've had some really, really big exits, and Solana is now super liquid.
Yeah. Isn't there one other element to the accounting within a fund that makes it pretty disincentivizing to for an LP to force their way out? So
trust Ledger to manage to bring up accounting, no matter what.
Wait, are we going to be the accounting crypto hour?
No, I think people love to see kind of the inside.
Next topic.
Of how.
What are the taxes like for a fund? How do taxes work? Can we get your tax advisor on the show?
Yeah, funny, we actually
I think people would like that.
Company, so I can riff a little bit, but
the reason
I suggest we
sometimes
if
you get an update or a year-end update, it might have a mark-to-market value, which is significantly lower than if you just take the kind of unrealized current market cap by tokens we hold, equity, whatever, add all that up, your mark-to-market or whatever might be 20, 30, 40% of that big total. So if someone says okay, I'm an LP, I'm out of here, get me out of here, you're actually only going to be able to really realize something that's way smaller if you force your way out versus the value that you see.
To be clear, so venture funds are generally closed-ended vehicles, meaning that you come in and then everybody gets out at the same time. A hedge fund, a lot of hedge funds are open-ended. So you come in and then you can redeem whenever you want or after some initial lockup. And then, other people will stay in and you individually get redeemed out. For that reason, venture fund accounting is a lot simpler because you don't have to deal with, okay, this person exited on May 31st. What was the price at that time? How much did they own? And blah, 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 blah. Venture funds make that shit much, much simpler from an accounting perspective.
Okay. So a hedge fund might be more similar to what I was talking about.
That's right.
Their investments might be much more locked up or various things, and so they come up with this mark-to-market thing, and then if you need to exit, that's
exactly.
Okay.
Exactly.
I'd love to ask some questions because, being a VC in crypto, you see pretty much everything, right? You see pretty much every project. I think only now is the first year where as an investor who is doing a lot of research and is deeply in the space, this is the first year where stuff launches and you're like, what? And then you don't even know any of the investors that are in it and you're like, how? That's okay, fine. So you see pretty much everything, which means you have actively made a decision to say yes or no to pretty much everything. And then everything goes up. So like without a doubt, there's a bunch of stuff on the top 100 on CoinGecko where you were like, no, this is not going to work. And it's like, maybe it hasn't even worked, but it's like fucking worth tons anyway.
Right.
So I want to hear some of your biggest misses.
You want to hear some of my biggest misses?
Yeah, the big fails.
Okay. So I want to first give a comment on the thing you just said, and then I can answer that question. So, like, every cycle, it always feels like this is the first time that something happened, and it's almost never true, right? Like, I remember all the crazy fly-by-night ICO flipping funds from 2017, and it looked very similar in that there was this random ICO, super fly-by-night team, raised a shitload of money from a bunch of VCs you never heard of, like half of which were in China. And then, they launched and it's like top 100 for like 4 days and then, it's churning out. And this kind of thing, it's happened before in different cycles. And as a long-term investor, one of the things that we look for is people who really are actually trying to build stuff for the long run and are not just trying to get rich quick. And the one thing about big cycles in crypto is that it attracts both. It attracts people who are trying to get rich quick. It also attracts people who like really see fundamental problems and believe in the space and want to be in it for the long run. So a big part of our job as VCs is finding the people who are just real people and have real ambitions and want to build something for the long term and partnering with them to help them make it happen. But yeah, misses, dude, we have had so many misses, like it's painful. I was actually, we were just talking a lot about Uniswap. Like Uniswap was one of the most painful misses of the last year because I remember we were talking to Hayden in their Series A and like Hayden really wanted us in the round. Like he'd read a lot of our writing. We'd written a lot about DeFi early on. And like, he was like, oh, you guys, blah, blah, blah. We like having this great conversation. And then we like pulled a bunch of data on Uniswap and we saw like 8 of the top 10 pools were not profitable since inception for LPs. Like, the highest volume pairs at the time were like SUSD, which was liquidity mine. And then there was like, what's the one, Richard Hart?
Hex.
Or Richard Lionheart. Hex, yeah. Hex was like the most liquid pool at the time. It was doing the most volume. And they're just like, yeah, I know. I was just like, this thing just doesn't feel like it's sustainable. It feels like market makers are going to come in and like do, direct market making on DeFi. We just didn't see it. We just totally fucking missed it. And that one was really painful because we just thought ourselves out of the investment. But I was looking back at some of our memos in 2018. And so I have seed round memos, like picking apart all the stuff that I thought didn't work about Solana. It was a 4-cent round. 4-cent round. Oh Solana, Terra, seed round. It's like all these, so many of the things in the top 100 I saw very, very early.
What the price of Solana is $138 ish?
No, it went up. I think it's like 160
okay,
now.
160. So like the daily volatility is like 100x of that seed, that 4-cent seed round.
Kinda, yeah.
That's fine.
Yeah. It was, looking back at that, I was like, oh man, I could be retired right now. Like that one is pretty special. But you know what? Kudos to Kyle and to Multicoin because they like fucking single-handedly made Solana their life's work and it paid off. Like it absolutely incredible outcome because I think they led the seed round and just they went overnight from being like a scrappy up and comer to like a titan just from Solana. I mean, obviously they've had a bunch of great wins like the Graph and Helium and a bunch of other stuff, but Solana is really what kind of catapulted them.
That made them stupid rich. That's like
yeah, absolutely. I remember seeing there was like some conference that Kyle was calling in like inside of a Lambo and just like on his
it was like last week, wasn't it?
Was it? I don't remember what. It was
some kind of conference call and somebody was screenshotted the Zoom and he was in his Lambo like screen sharing or whatever he was doing.
That's right. Right. So
I guess they're just living their best life now.
So, wait, he can't afford a house? He's living in his car or what?
That's probably what he's trying to show. He's humble. I think that's what's happening.
Right. I think that's like that is a great example of like you only need one big win in crypto. Mm-hmm. I think a lot of people that like come and try and make it their time horizon for a position is like 7 minutes or something. I did a poll on Twitter earlier, and I said, what is responsible for your biggest gains on your portfolio, and what is responsible for your biggest losses? And the biggest gains was just like simple spot trading majors and buying tokens, like buying smaller cap tokens. And what was responsible for the biggest losses, like over 50% was leverage trading.
Yeah.
And I think people come in with this really short mindset of like, right, I'm late, I've got to catch up. Some people have already got billions of dollars. I've got like 2 ETH or something. The only way to catch up is to use debt, because I'm not missing out on this. I'm going to borrow money and go leverage trade. Really, like Multicoin did that seed round, what, 2018 was it?
Yeah, it must have been 2018 or
2018.
2018. So it was like
2019.
It was 3 years to go from like, a few million to to several billion.
Yeah.
And they didn't do it. They just sat there. And I saw another thing the other day where an Ethereum Genesis wallet, someone put $1,000 into the Ethereum ICO, and then they moved a third of that into the Avalanche ICO. And in 2 trades, it went from $1,000 to 600 million. Like, they did 2 trades. They just sat on it for like 5, 6, 7 years or whatever it was.
That's amazing.
And you only need to really hit it once. You need to be right once. You don't need to be right every single day. You don't need to play every single thing. You got to be right once.
Problem is,
if you can make 10 bets and be right once, sounds easy, doesn't it?
I do think the 10 bets component of that is important, because somebody else probably put $1,000 into the ETH ICO, and then they rolled their 100x and they put it all into Ryblocks, or I don't know, what's something that went to 0. Like they rolled it, and then it that next thing then went to 0, so they still didn't make it. And if you're not throwing a handful of like smart darts, then you can still screw it up, because you can make that convicted bet and you're completely wrong, still goes to 0. But man, you hit the one and it's like, well, suddenly that one dart is like 90% of my portfolio.
Yeah, that's what I think about. It's like making like 10 sort of high conviction, like thesis driven, I think this, and just like watching them really carefully to like figure out, are the things that I expected to happen happening, or like, am I wrong, am I right, and why? And just fucking leaving it, rather than going, all right, well, I making a trade on this for the next 3 days because Axie's pumped, which means there'll be like a mimetic pump in this thing. And then I'm going to rotate the capital to DeFi on Algorand because Gary Gensler mentioned Algorand in a talk 7 years ago.
Cobie's mocking right to my face.
That wasn't even about you. But, if it applies, then yeah.
It is one thing, I don't give investment advice. I charge for it, but the one thing I will say is that diversification is really fucking powerful. Especially, it's kind of the core of venture, right? That's how venture works. Like Multicoin didn't put that much money into Solana, but the amount they did, they had a portfolio of many, 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 many things, and just one of them was 1,000+X, and returned that fund many, many times over, and probably made them the best returning fund of that vintage. But the thing is, if you have returns that are power law distributed, meaning that you guys are familiar with the concept of power law. If returns are power law distributed, then the optimal strategy is actually to be maximally diversified. Now, if you're doing venture, that's kind of hard, right? It's hard to meet all these entrepreneurs and put all of them in your portfolio and negotiate all these deals. It's actually not easy to do. In liquid markets, it's really easy. It's really easy to have an extremely diversified portfolio. So one really easy thing is trade less and diversify more.
That diversification, though, it's got to be important on when you do that, because if you diversify when it's
at the top,
then the correlation is at 1, and everything goes down 99%. But if you
to be clear, I'm not saying diversify to mitigate losses, because you're right, everything is correlated, especially in massive up and down movements.
Yeah.
I'm saying diversification to increase your returns.
Right. Yeah.
So there's diversification in traditional markets, which actually mitigates risk. Diversification in crypto can only somewhat mitigate risk. It does a little bit, but not super a lot.
Yeah.
It actually amplifies returns because of the power law nature of of returns.
And you talked about like your LPs, like bad instincts too, is like if you're making those diversified bets amongst great teams who are survivors of a long bear market and have these great ideas, and you're like, look, we're putting $1 million here, $1 million there, 200,000 there. And then you're like, that's those really powerful diversified bets with the power law of distribution. But man, if you like, how many funds launched in 2017 and the bear market couldn't end until like they shut down, like there were lots of funds that shut down in 2018, 2019 because they couldn't survive that. They weren't preparing themselves to be able to like make the next kind of big power law bets. And I used to mock the idea of like a moon bag, but now I've seen enough stuff where it's like, yeah, look, it looked amazing at $5 and now it's 500 and I'm an idiot because like I sold it all. Yeah. And it's just, it's incredible to see the way the cycle really works, because when it's going up, like stuff will go up so much more than you anticipate.
That's right.
And like my
venture
self wants to like get out, and I'm missing that power law escalation. Right.
Right. Venture really trains you to think that way. Like venture is all about power laws. It's all about like, look, a lot of great entrepreneurs, usually like 5 or 10 of them are going to arrive at amazing things, like the Uniswaps, the Solanas, but the Avalanches, the Near protocols. And when they do, like it's always bigger than you think it's going to be. And even when you already think it's big, it gets even bigger than that. So, VCs have been doing this for a long time, whether in traditional technology companies or like Google and Facebook. Like remember Facebook's IPO when it was like, in single digit billions, and then now it's like a $500 billion plus company. And every time people think that something is overvalued, usually they don't understand.
They were mocked for Instagram.
That's right.
Incessantly.
That's right. They were mocked so brutally for Instagram.
Zero revenue, 1 billion. I guarantee you from my personal Twitter account, I have something where I'm comparing like something to how many Instagrams it is. And you look back at it, it's like, well, it's probably like the second most valuable singular, centralized software brand in the world or something. It's
That's
like,
right.
it's crazy.
And then WhatsApp on top of that. Which also was
that was like 20 billion, and people were like, you're absolute morons,
Yeah.
I don't know what WhatsApp is worth today, but it's a lot.
On the diversification thing, also, I hope we get a diversifier meme. Maybe it already exists, but I haven't seen one. If so, one of my friends, maybe you'll come on, maybe you won't. We can ask him. One of my friends, not like super crypto native, but knows a lot about traditional finance. He's in his 20s, young guy. He's like financially independent and just does traditional investing. Got into crypto basically 2020 and didn't really know what he was doing. So he was like, look, I'm taking a shotgun blast approach where like I'm going to invest in everything. So I have to pay attention to it all. Mm-hmm. And then I'm going to sell the stuff that does badly. And I'm going to add to the stuff that does well. And hope for the best. And he started out, I think, with like investing in like 60 or 70 things. And over, I guess, his 18 months or like year and a bit in crypto now, he's narrowed it down to owns like 15 or so now. He was really early to like Solana, really early to a bunch of stuff that did really well, and just kept adding to it on the way up and cutting from the stuff that was just not going anywhere. I think it's like a pretty good strategy, honestly, for someone that doesn't really know what they're doing. Like you have a forcing function of like, I have money in this thing to at least pay attention to it, to like cut, like avoid opportunity costs of having it in bad assets by like pulling from the ones that are not doing well, and adding to the ones that are like sort of catching on, and then learning about why they're catching on. So it's like, all right, is this like the top of this thing, or is it like, is this catching on because it's going to be important throughout the cycle or something?
What you just touched on, we've talked about two different concepts in this episode. One is how to be contrarian, and then one is how to be like momentum driven and like being able to do both. And a lot of times a contrarian investor gets totally stuck on averaging down on the losers. It's like, I will be right eventually, and then they're just never right. But then the other side of that,
it's like you and Curve.
It's just my stable coin, but actually, I did eventually dump it, collected my yield over however long. I think it's doing fine now, but eventually I did chase some momentum with that and it did fine. But in the right markets, you just have to chase momentum. A better example than Curve for me is like, I've thought ever since the day it launched that 0x is a great idea, like the pipes underlying crypto, all this infrastructure stuff. It was 25 cents when it launched in like mid-cycle 2017, and it's a freaking dollar today, you know? And if you haven't can't 4x like in shitcoins elsewhere, like that's very problematic. And at times, like I've been really convicted, like this is a fantastic protocol, fantastic team, fantastic tech. It does not make the number go up. And if like to your friend's point, if the number cannot go up, like you have to make other plays. You cannot put your fate on the fate of something that continues to underperform. And like, hopefully this marks the 0x bottom, because I would love to buy it, but like it doesn't, I'll buy it when it has momentum, you know, and like you cannot just constantly have that. The only time you would do that when you are the team and you have the control to like make the difference. But if you're not in charge, I don't think you can carry that conviction. I think you have to have like softer hands than that.
Although as a counterpoint to that, like, so to be clear, when Multicoin led the seed round and the Series A for Solana was the ugly duckling. Like there were no top tier VCs who were trying to get into Solana. They pitched everybody. They pitched Polychain, they pitched Andreessen, they pitched us. Everybody said no. And Multicoin just kept fucking driving. They just kept saying like, no, I believe in this team. I believe in the vision. I'm going to fight for these guys until they make it. And really with Solana, I remember when they came out, it was like still sub $1. I believe it was like maybe about $1 or something like that when it finally token was tradable. And it was when basically, I believe it was set up by Kyle introducing Solana to FTX when FTX was first thinking about getting into DeFi. That was really the shot heard around the world that started Solana's huge ascent. It was like the marriage between Solana and FTX. And all of that was just Kyle putting in the fucking work and grinding in something he believed in. So that be, you know, I agree with you that obviously momentum is a big part of crypto and markets in general, but there is something to be said for just really believing in something.
I think they forced a seat at the table at the same time. They had an impact on the direction of.
Oh, absolutely. Absolutely.
Not to belittle like the team themselves. We topped Solana, unfortunately, local top.
Temporarily.
They eventually got over it. I don't know if
the curse is not permanent. It's just like it's like COVID. It goes away.
Permanent curse.
Yeah.
But
there's a little impermanent losses.
Yeah, but they're like that was a kind of group effort, right? Of you got to have the hype, the tech, the bunch of things kind of line up to work. But they did definitely force themselves into that conversation of being part of the narrative for Solana and making the intros and doing those things. And I think that was an important component. But I don't know, like I've seen some people like Zcash is another tragic one, right? Like how many Bitcoin per Zcash, like early days and down 99%. Like
literally down only. It's just literally down only.
Down 99%.
Opposite of what you want.
After down 99%. Like if you go all in on that, you're just screwed, you know?
I'd love to talk a little bit about we're talking about Multicoin and Solana, like that conviction. Made me think of this because they also invested in EOS, right? So you can go like, on one hand you can be like, it was just luck, like they were just fucking doing everything. On the other hand, you can say, well, they realized early that there was a thesis for alternative layer ones. They saw Ethereum scaling issues coming up, and they thought, well, they said, well, Bitcoin's won its category, and smart contract chains will have to compete forever. Therefore, there's a lot of value in betting on smart contract chains that potentially can try and unseat Ethereum. And then they invest in a bunch of things within that category. And maybe Solana was the best one, and they helped push it forward. And this year, you've seen that thesis or that narrative come into fruition because Ethereum is not usable for anyone that's not like a millionaire. And Binance had its moment of onboarding tons of people onto an Ethereum clone. And DeFi kicked off there, and loads of rug coins kicked off there. Avalanche season Avalanche August just happened, where
it's like just ended.
Avalanche August is in the past. And there was a bunch of stuff popping off at that time, like even Polkadot's temporarily looked all right again. And, so that alternative layer one thing sort of maybe stemmed from Solana going so crazy and Ethereum being so shit, but that has been a really, really, really big narrative this year. How do you see I guess like the multi-chain future? Like, are there going to be a couple of winners? Like, is half of it just vaporware? And B, how do you see like the long term playing out on these things versus Ethereum?
So this is a tough question. So it's certainly true that Solana's taken off. Also, Avalanche has taken off. Binance Smart Chain, Polygon, they're all kind of in the game now. And then of course you have layer twos as a separate approach, shot on the same goal of how to scale smart contracts. The big line in the sand is basically between non-EVM chains and EVM chains. And Avalanche is on the EVM side, Solana is on the non-EVM side. And from the beginning, actually, you could argue that this is the multi-coin thesis. EOS was also non-EVM, right? EOS was like you had to program in C++. They have their whole different programming environment. Multi-coin thesis from the beginning has been that, it's really all about performance, and it's all about really developing a tool chain that normal programmers know how to use. And which, not that Rust is like that easy for normal programmers to use, but it's not Solidity. Whereas for my thesis from the beginning has been that the EVM, Ethereum's virtual machine, is basically the lingua franca of blockchain programming. And everybody at this point, all of the tooling, all of the security software, all the auditors, all the developers who actually understand how to build smart contracts and smart contract security, all of this stuff has been built with one ecosystem in mind. And it really harkens back to the history of web development. So, in the dawn of web development, JavaScript was a language written in, 5 days by Brendan Eich back when he was at Netscape. And it was just an absolute piece of shit. It was horrible. It was like really, arguably it's gotten a lot better.
Yeah.
But it was really a terrible language, right? It was clearly written by non-experts. There was no programming languages like theory behind it. There were a bunch of footguns everywhere. It was not very performant, but it sort of became the de facto language of the internet. And everybody started building tooling around it, security stuff, all the browsers supported it, and it became just the thing you had to write in. And even though it sucked and there's so many better languages out there, it's like, look, this is the thing we're all stuck with, right? It's like English. English is kind of a horrible language. It's got all these like weird Germanic things and Latin things and Roman things, and you just kind of threw them all there in this big hodgepodge. And like, you try to teach somebody English and you try to explain to them like how different tenses work and like why certain word orders mean something else, and they don't get it. It's totally unintuitive. That's the way that programming languages actually evolve. It's always really random and arbitrary, and it's super annoying, and it sucks, and it's suboptimal. And in 2017, everybody looked at this. Like, EVM was all written by Gavin Wood, and Gavin Wood very clearly did not know very much about programming language design or virtual machine design, because the Ethereum yellow paper is a fucking nightmare. Like, the VM design is terrible, but it doesn't matter. It's been 5+ years now of everybody who's doing anything important building on this infrastructure, and everybody has now learned how to use it effectively. So it feels like we're in the same position that we are with JavaScript or with English, that EVM is going to be the way that smart contracts get written now and potentially forever. And it'll probably iteratively get better, and people will find ways to make it more efficient, more secure, more whatever. But like, it's going to be slow iterations like it is with JavaScript, and it's going to be backwards compatible with EVM like forever, because that's just the way it's got to be. So that's my thesis. And under that thesis, like, Solana is working on an EVM compatibility layer with this thing they're working on called Neon, but it's going to be virtualized. So it's going to be like on top of Solana. So it's not like native. And that means it's not going to be as performant as it would be if you have another chain like, an Avalanche, or like what Near is trying to do with their protocol called Aurora. It's not going to be direct EVM running directly on a consensus layer. So that is what I'm bullish on. It's obviously true that it may end up being that another architecture ends up winning, but most likely, judging from the history of technology, my bet by and large is that it's probably going to be EVM native. So that's my view. Now, in the broader scheme of things, there's layer ones that are EVM and non-EVM compatible. There's L2s like Optimism, Starkware, Matter Labs, Arbitrum, and then there's like interoperability solutions like Polkadot or Cosmos that allow you to like have these separate blockchains that connect back to Ethereum. And so far, actually from the very beginning, my thesis has been broadly that most likely the layer ones are going to end up winning. Out of all those solutions, they're all kind of trying to do the same thing, right? They're trying to scale smart contracts. I think the most likely architecture that wins is that there are other layer ones that bridge back to Ethereum. And maybe they're going to be augmented by other layer twos and other things that are more application specific. But the broad thing of, especially in the early days where there's so much interoperability, we don't really know exactly what we want things to do. We want a lot of composability. We want it to be easy to build. That feels to me like the architecture that's probably going to win in the near term.
Well, man, I have a couple of things.
Yeah, I like the blowing the air out, like you were like, gone. Here's with it, Ledger.
That's like one of those. Frexley, take the clip, run it, put it on Twitter as its own little 3-4 minute.
There you go.
I really like that. That was. I didn't have very many cheat codes. I'm like perfectly 100 IQ coming into crypto. But my one cheat code was definitely that idea of network effects that I saw from open source in the web. I actually came from the WordPress space, which is like peak type of developers hate it type stuff. But it was super easy to deploy.
For the record, it's also peak Ledger.
Yeah, super easy to deploy on a MySQL stack, like super standard, and it just didn't matter that if the code's a dumpster fire or whatever else. It's like it became ubiquitous and went from 1 or 2% of the web to like 40% of the web of like websites with content management system. And I saw a lot of the same type of stuff like be eligible in the crypto space, and specifically with Ethereum and EVM and terrible design and yada, yada, yada. But it's this cathedral in a bizarre type of concept for up-only bingo players. Like there's your obscure corner piece, where the bizarre tends to like figure itself out, and the cathedral is much more of a like high dollar bet that may or may not work. You may build it and nobody ever comes, and you may build it and it's perfect, but like you don't necessarily know during that build process whether your cathedral will end up with visitors, whereas the bazaar develops naturally. And I think that's kind of the empty cathedral of EOS, or like the maybe they're going to make it cathedral of Solana, versus the like certainly going to make it at least to some degree of EVM. So I'm really glad you brought that up, and it aligns with my thesis. My question for you is like, what does differentiate the layer 2 stuff versus the layer 1? So like layer 1 EVM, Avalanche, C-Chain or whatever. Layer 2 EVM, either some like ZK or optimistic solution for layer 2. What do you think differentiates those? Because I feel like from a user perspective, it might end up feeling pretty similar, but I'm not sure. I want to know more about that.
Yeah, so one big difference is one of constraints. So if you're a layer 2, you are very constrained. How are you constrained? You're constrained by your security model, right? You have to be, if you're an optimistic rollup, then we have to have a 1 week delay period in order to get things on chain. We have to pay this amount of money in order to actually put your call data for the, corresponding to your transactions into the, subsequent block when we anchor this layer 2 block into the main blockchain. There are all these things that you have to do. You're not super flexible, right? And if there's a bug in the layer 2, it's not super easy for you to like hard fork or like move things around or like kind of fix things, right? If you're a layer 1, then it's your show. You're on your own private island. You can do whatever the fuck you want, and you can fix things. You can move fast. You can iterate. You have a lot more flexibility. And it feels to me that's one of the reasons why I suspect that layer 1s are like, I had this thesis a while back before we really saw it. We've already now seen it in multiple iterations, right? Like, there was a time that Arbitrum was down for like 2 hours, and the ability for people to use Arbitrum or use these, right now Optimism like doesn't even have like a fully functioning mainnet yet. And a lot of the reason why this is that they have these really hard technical problems they need to solve, and they need to get it perfect because they're anchoring into layer 1. And if they don't anchor correctly, they could lose all the money, right? Whereas if you're a layer 1 and things, something goes wrong, you can just go fix it. You can go hard fork and be like, oh no, sorry, that wasn't supposed to happen. And
bullish rollbacks.
Bullish rollbacks, exactly. I mean, look, I think it's a real thing, right? Like in the beginning of any project, there are going to be bugs. There are absolutely going to be bugs. And one of the things that people right now are not understanding deeply about layer 2, there are going to be failures in layer 2. There are absolutely going to be bugs and things that people get wrong. And like, it's early days. This is brand new tech and we just got started with it. So expect there to be failures. And I think the first time there's a major failure in layer 2, people are going to freak the fuck out. For layer 1, if there are absolutely going to be bugs in layer 1, but it's much easier to remedy a bug in layer 1 because you control everything. So I suspect that what we're going to see, and we've already seen this to some extent, layer 1s can just move way faster, right? Polygon, Avalanche, they're live, they're here. They're giving you the experience that Rollup said they wanted to give you a year and a half ago when they first started announcing, hey, we're going to do all these rollups. And so then between optimistic rollups and ZK rollups, of course, the one rollup that's really live and has a lot of TVL is Arbitrum. And what they have is pretty real, but the fees are not low. Like the fees are significant. They still have the 1 week withdrawal period, which is a pain in the ass. And then I think in the long run, when you're having something like that competing against these other layer 1s that can be way faster, can have much lower fees, can iterate more quickly and be more coordinated in bringing ecosystem and partners on board. The other big thing about them that I think is also really powerful is that between optimistic rollup and ZK rollups are harder. It's more difficult to get general computation on a ZK rollup. Cryptographically, it's just actually a hard, cryptography problem. But once they solve that problem and they get functioning EVM on these ZK rollups, there's so much more that you can do with ZK technology than you can do with an optimistic rollup. The upper bound on what's possible in terms of recursive snarks and recursive computation, there's so many more things you can do, because the thing about cryptography is that it only ever gets better. It only ever improves, right? Like what we were looking at 4 years ago, you're talking about Zcash, right? V1 of Zcash was an absolute nightmare. It was like it was using like one of these computers from like the 80s where like it takes like 20 minutes to boot and you have like these floppy disks. That's what Zcash felt like in the very beginning, right? Now we have ZK proofs that can run extremely fast, extremely efficiently. We've got hardware accelerated provers, and we have this ability to do recursive proofs, meaning you can prove a previous proof. You can prove like a chain of proofs. You can say like, I have proof right now that I've done 500 other proofs that every single block prior to this is correctly constructed, right? What does that do? How does that open the design space for what you can do within blockchains? I think it's going to be absolutely huge. It's going to take time though. It's nothing you're going to see this year, probably not even this cycle. Are you going to see what ZK rollups can really do once they start really refiguring a lot of stuff in crypto? But if I had to guess, if there's going to be an Ethereum 3.0, it's going to be based on ZK technology.
Oh God, not 3.0. 2.0 is not even out yet, mate. Come on. It's like doing Toy Story 7.
Yeah, I know. I'm just laying it out there.
You got to stick around for a whole other cycle of version.
I'm not doing it. As soon as E3.0 comes out, I'm throwing my phone in the river. I don't care. I'm done.
Well, luckily, you won't need very much hardware to verify it once we get.
Look, at the rate of the speed of ETH2, I'm going to be in my 80s before ETH3 anyway. I might not even make it to see ETH2 launch. I don't have a very healthy lifestyle.
Fair enough.
We got some ZK stands in the chat talking about like Starkware in November and some other stuff. Let's assume ZK stuff, they figure it out. What impact does that have? Like, I mean, Avalanche seems like one of y'all's bigger bets. Fun. So, like, what impact does scaling and various advantages that you get with ZK and ETH layer 1 or ETH layer 2 ZK rollups relative to like Avalanche as it stands today? Like, is there a marriage there? Does Avalanche still work, or is Avalanche a medium-term solution?
Right. So here's how I'm going to frame my answer to that question. There's an analogy that I like to use. Usually when we talk about blockchains, we talk about them as networks. And I think that's it's not a very good metaphor to use, because it makes people think about networks like Facebook or something, or Google or the internet, which are these networks that are infinitely scalable, or at least that we figured out how to scale pretty arbitrarily large. And blockchains aren't like that, right? Blockchains are more physically constrained. And I think it's better to think about blockchains as being like cities. So if you imagine Ethereum is like the capital city of everything in crypto, right? Just like New York City. It's this huge financial center, but the problem with Ethereum is it becomes super expensive, right? There's crazy congestion all the time. It's really tough to get an apartment there. Everything's super expensive.
Francisco.
All the richest people live there. It's like super ballin'. It's super wealthy, and like the biggest banks in the world, they'll all set up shop in New York City. But for most, everyday Joes like you and me, like we're not necessarily going to want to live in Manhattan, right? So where do we go? How do we scale things? How do we scale things past Manhattan? And if you look at other layer ones, L2s, and interoperability solutions, they're all different answers to this question of how do you scale Manhattan, right? So if you look at interoperability solutions, right, like Polkadot or Cosmos, what they say is like, okay, how about this? How about we create like a big network of lots of little mini cities and we'll connect them up with this big highway system, right? And so you could create a little city and have like some little banking thing over in that little tiny city. You could have a little mining town over here and there's like a highway system that connects you to that. That's the vision of something like Cosmos or Polkadot, right? Now, if you look at another layer one basically says like, look, how about we create like another dope ass city like Chicago? And it'll be totally separate. It'll have its own financial centers. It'll have its own people. It'll have its own railways, and everything will be kind of recreated in the separate city. And we're just going to create a bridge back to the original city, and so people can go to Chicago or they can go to New York or Boston and New York. Right? You just take the train, and it doesn't take you that long to get there. But like it's totally separate. It has its own infrastructure, own unique identity, right? And it's pretty clear that like that is working right now. That's what you're seeing on Polygon. That's what you're seeing on Avalanche, is that you have your own AMM, you have your own DeFi protocol, you have your own lending platform. Like all these things are being recreated, but separately. So it's like you have your own little ecosystem that's similar to what they have in Manhattan, but it's cheaper, it's more scalable, whatever. The third approach is layer twos. And a layer two, I describe as like, instead of trying to build horizontally, you build vertically, right? And you say, okay, instead of like trying to go build a separate city, instead, we are going to invest in skyscraper technology. And we're going to build bigger and bigger skyscrapers in Manhattan to scale Manhattan, which you can do that. That totally works. And we're figuring out the technology in order to build these skyscrapers. It doesn't scale you infinitely, right? And there are limitations. Like, look, you build taller and taller skyscrapers, like the streets are still really congested. Like it's still really hard for people to move into the ultimate city. Like moving between the skyscrapers is still really hard, right? Like there's only so much you can do by building more and more skyscrapers in Manhattan. It does help at the margin, but it's sort of an and not an or, the way that I see it. Layer twos absolutely will be important, and they will exist, and they'll find ways to make them more verticalized within different ecosystems, but you still need to scale the base chains. It is not enough to say there's going to be 50 different rollups on Ethereum, and also because of the just the nature of rollups, they do have kind of a network effect, right? There will probably be a lot of rollups, but there will probably be a lot of rollups on many different chains as well, and there'll be one component of the way that scaling is going to happen.
Shard 42
I got some questions which are yeah, it is going to be real. I got some questions, but it's like lowbrow, and maybe
therefore perfectly appropriate.
Okay,
Tailored.
perfect.
Yeah.
Lay it on me.
Tailored to our show more than tailored to your thesis. But I like the idea that layer one blockchains are cities, and you said Ethereum is New York. So I'm just going to give you some layer one blockchains, and you got to tell me what city it is.
Oh, perfect.
I told you it was lowbrow. Look, it's up only TV. It's not like fucking Bankless or something. Bankless, they like research and do everything. We're like, all right, what city is this? All right, what city is Bitcoin?
Bitcoin is Atlantis.
Wow.
Atlantis. All right.
Yeah.
Fictional.
Or Rome.
Underwater.
Rome.
Underwater.
Rome.
Shit.
Rome.
I should
Rome.
have gone with underwater. I should have. Oh.
Rome. I take it back. It's Rome.
It's Rome. Oh man.
Bitcoin's Rome. Bitcoin's Rome.
All right.
So they're
what
like Roman
is-
coins. That's there.
There you go.
Yeah, fine. I'm annoyed with myself that I didn't say underwater. I said fictional
He
first.
had the perfect joke, and he had the second best joke instead.
What is
By the way, Atlantis is probably real. Probably real. Not actually underwater, but probably real.
Yeah, but is Aquaman real?
That's a good question. That's a good question. That's a
What
little
is
too highbrow for me.
what is Solana?
What is Solana? That's a really good question. I think Solana could be Singapore or it could be Brasilia.
All right. What is EOS?
What is EOS? EOS might be Atlantis.
What are those? What are those?
I don't
What
know,
are
I
those
don't know.
Chinese like empty cities, like the shadow cities?
Yeah, exactly. That's a good way to put it. That's a good way to put
It's
it.
like-
Yeah,
Oh yeah,
it's like a ghost city.
Yeah.
It's like a ghost city.
All right. What is Cardano?
Cardano, oof. What is Cardano? Cardano is like, I feel like Cardano is like, it's like the Beijing Olympics, like Beijing during the Olympics, right? Where like they sort of turn this like Potemkin village all of a sudden, where like suddenly the air is clean, and now suddenly like, the moment you look, it's like this amazing thing, but when you look away, it's like
so
a
brutal.
bunch of poor people in tatters. And, you know what I mean? Like
Yeah.
that's kind of what I feel
They
like
like
Cardano
stood
is.
up the city just for the Olympics, and then it
Exactly, just so that people could see how beautiful it is, and then the moment you look away, it's like, oh, no,
my
it's,
gosh,
it's
that's
not
so
really like
brutal.
that.
What about Litecoin?
Litecoin, Litecoin, I feel like is like Detroit or something.
Oh man.
What about Monero?
Monero, oof. I would say Switzerland, but Switzerland now has new connotations, right?
Yeah.
Maybe like Hong Kong or something. I don't know.
I like that.
All right, last
Yeah,
one.
or Monaco.
Zcash.
Monaco.
There you go.
Monero's
Monaco, yeah.
Monero's Monaco.
Fair enough. And Zcash, last one.
Zcash is like Transylvania.
Is that a real place?
Yeah, that's a real place.
It's
right?
not just like a Disney movie or something.
No, Transylvania is like a real place where they place a lot of the vampires, like where they came from. But no, it's a real place.
A place in Romania. Oh yeah, they got like these yeah.
Yeah, it wasn't. What's that movie? That famous movie that was based in Transylvania. Black and white film. How am I forgetting the name?
I don't know. I don't know any of these types of things.
Okay, whatever.
I'm like the
whatever.
worst.
Hotel Transylvania.
Hotel Transylvania. No.
That's a good movie.
Oh my God, it's like the one where they're
Dracula.
no, not I mean Dracula. Yes.
Van Helsing.
Transylvania. Hold on, I gotta look this up now. How am I forgetting this? Maybe I'm totally wrong, by the way. But there's this famous film where like they're in a hotel. Okay, it's just telling me Hotel Transylvania. Like I'm looking at Hotel Transylvania.
It's one of those ones where you look at a word and you're like, "That's spelled wrong," and you think it's
Yeah,
spelled
I'm
wrong.
looking-
But it's
okay.
definitely spelled right. You had it. You just doesn't look right.
Yeah. In popular culture, Transylvanian popular culture. Here's the article. Let's do this. Films.
We're digging deep.
Yeah. Shit, maybe I'm wrong. Okay, maybe it's not in Transylvania. My Fair Lady was in Transylvania, but no, this is not.
I think Aquaman
All right.
is Peter McCormack, by the way. Just like wearing a Metallica T-shirt.
Is that right?
Yeah, it's just Peter.
Okay. Shoot. All right. I don't remember what movie this I'm thinking of.
Or Jack.
Maybe more serious question about some of the coins we mentioned, specifically Monero, Bitcoin, and Cardano. Bitcoin's had kind of a weird cycle, right? Where they've had, I guess, some of the biggest things to ever happen to Bitcoin have happened this cycle, in that El Salvador has decided it's a government hobby or legal tender and stuff, and
Right.
know, China has had an exodus of all miners forced out of the out of China, and it survived it. You had Tesla both buy and sell Bitcoin, and like the sort of treasury adoption of both countries and corporations sort of happened cycle. But at the same time, from a price perspective, has underperformed basically everything else in crypto that didn't go to zero or something. So how do you see Bitcoin fitting into the ecosystem, like now and over the next few years?
I mean, I don't think I have a very interesting answer to this question, but I think Bitcoin, we kind of understand what it is now, right? It's sort of a macro asset. It's it's kind of anodyne at this point. Like no one's really scared of Bitcoin. Nobody's really threatened by it. There was a moment in time where we were like, oh man, what if governments are going to 51% attack this thing and they're going to buy up a bunch of whatever? And the answer is like, no, they just like will ban it if they don't like it. Otherwise, it's like, whatever, just like go trade your Bitcoin. I don't really care. So it's kind of like gold. And to the extent that, there are a few countries that have intense capital controls, like India and China, which in fact are exactly the companies that have been most inimical to crypto on the regulatory side. For the most part, most countries don't really care if you own gold. And if you want to buy gold and sell gold, it's like, yeah, do that. It's fine. So I think Bitcoin at this point is, it is what it is. It's a crypto asset that's digital gold. It's going to keep growing and keep getting more and more. The biggest thing for Bitcoin is that it just doesn't, as long as it doesn't die or break or shut down or schism, it's going to go up. Because the thing that makes Bitcoin now more institutional is just the fact that it's been around for a fucking decade and it's just held up. And, a lot of people in crypto tend to over-index on technology, and I'm definitely guilty of this many times, that the real thing that's important is to keep innovating and be at the cutting edge. It's like, well, why doesn't Bitcoin have DeFi? Why doesn't Bitcoin have NFTs? Why doesn't Bitcoin do this thing? And the answer is like the reason why people are more and more institutions are getting open to buying Bitcoin is because they've just seen it be fucking, just like it's a rock. It just stands there and just is Bitcoin. And as long as it keeps doing that, it's going to keep winning. And more people are going to own Bitcoin and put it on their balance sheets.
Maybe Bitcoin is the original NFT.
Hey, that's good. There's 21 million CryptoPunks, or 21 million.
Small collection.
Exactly.
Like no picture. The technology wasn't available for the pictures yet.
Exactly.
But for most NFTs, there's no picture anyway. It's just a hash. So same thing.
Exactly.
You think you think of like beta in the price movement of assets, like the beta for Bitcoin will continue to go down over time so that it's less of kind of an asymmetric growth bet as it continues to mature?
Yeah, definitely. I mean, well, the reality is like Bitcoin is so big now and it's such a liquid market and there's so many players in sidelines waiting to buy dips that it just takes more money to move Bitcoin. So there's just a kind of, very obvious reason why if the market's moving and people are getting excited about crypto, it's a lot easier for a lower stock asset to move than for something like Bitcoin, which is the big kahuna. So I think that there's going to be, we've already seen it, right? Like since COVID, there's been increasing correlation between Bitcoin and the S&P, between equity markets. And that's really a function of more and more institutional investors who have exposure to the equity market owning Bitcoin as another growth asset in their portfolio. Bitcoin people often get triggered when you call Bitcoin a growth asset, but like if you're investing in something because you think it's going to go up, it's a growth asset, right? Like that's the whole point. So
wait, is that what a growth asset is? I always just went, oh yeah, growth asset, but it's just going to go up.
Yeah, you're investing for growth, right? Like you want something to grow.
You can't
I'm so stupid.
You can't earn yield very easily on your Bitcoin. Like sort of like a dividend generate. Like if you own Exxon, it's not necessarily because you think Exxon's going to be so much bigger in the future. It's because they have a 4% dividend on average or something.
Right. I mean, to be clear, like a lot of these companies are doing buybacks now. So like dividend buyback is economically equivalent. Doesn't really. But the thing about Bitcoin is that, people still believe that a fraction of the people who are ever going to own Bitcoin. So if that's true, then if that fraction is really, small relative to what it'll eventually be, then great, this thing can 10x. So, it's hard to see Bitcoin 100xing from here for obvious reasons, like just literally like the TAM of everything in our economy. I don't think Bitcoin itself is going to increase the economy that much, but can it absolutely steal a lot of the market cap from other things that we think of as store of values? Absolutely.
Yeah. My gut says that like Bitcoin will continue to be better at preserving buying power in each bear market. So what did it go down last time? 70%. And the time before that, 85% or something. Maybe next bear market, it goes down 60%, while like all this like hype stuff continues to go down 95% or whatever. And, but it'll just continue to underperform all the like goofy new stuff each bull market. So like, I feel like the later in the cycle we get, the smarter it is, I guess, to own Bitcoin. If you're only a rotator, like you don't go back to cash necessarily, you just want to preserve your buying power a bit better. But I just don't see the upside necessarily in like an emerging bull market or like the height of the bull market to where you're really going to outperform in Bitcoin for like long periods of time.
Yeah, I mean that generally sounds right to me. That generally sounds right to me.
I was going to ask a bunch of other things. I realized I don't actually care. And Cardano was just a dunk on Cardano. Cardano is like, Cardano Monero was like, do I actually care? Do anyone listening really care?
Hold on, you're about to
much?
get the Cardano crew. What do they call themselves? Is there like a name for the Cardano troopers?
I had several things come to my head, none of which were polite, and none of which am I going to render into the real world.
No wonder you guys are the pros. You clearly know.
They call themselves Charles Hoskinson YouTube subscribers, I think. Subscribers, I think, is the term.
Is it the term?
One question we do ask a lot of people that we haven't brought up with you yet, because we spent so much time on layer 2s and layer 1 type stuff. Is there like a category that you say, you got 2 more years of bull market, don't worry about cycle stuff, and it's just a category of crypto that you're freaking excited about that's like not really made it to the forefront yet? What category do you love?
Oh, that's an interesting question. It hasn't made it to the forefront yet.
Or just has like outsized potential within, like as a pie chart will become much bigger within the crypto ecosystem.
I mean, there are a lot of things I think will become much bigger, but I feel like crypto at this point is pretty, I feel like so many of the things that I thought were like very, very deep cuts have become very mainstream in the last couple of years. So like, I remember, like I told you guys, I was working on NEV before it even had a name, and DeFi before DeFi was called DeFi. And now these things are so mainstream, like, just randos know about NEV and like will invest in. I was like, I think NEV is going to be hot this month. We're going to buy some NEV tokens. I think there are a lot of things that I don't think there's anything that would be surprising to you guys and that you haven't heard of that I'm excited about. But a lot of things that I think are still underexplored and underappreciated. We had a thesis for a long time that on-chain derivatives are going to become increasingly important. And really, it was like a month ago that DYDX just like took off like crazy.
Their volume's already like bigger than everybody, isn't it?
Not everybody, but they have actually their liquidity is deeper than anybody on screen. Apparently their liquidity is deeper than Binance's for the ETH perp.
I saw it was like at least comparable or something somewhere to Binance and FTX or something.
Yeah. Antonio tweeted, I think like it was last Friday, that they had twice the depth at 50 bips compared to Binance or FTX.
I think I saw one day they had more volume than every other DEX combined as well or something. Easily. I mean, relative to CeFi, relative to like regular exchanges, it's still pretty good. DYDX is doing absolutely amazing. And so that was one thing, again, that we bet on them very, very early. And we believed in the space when nobody else really did. And it was kind of limping along. And then token model, Starkware integration, boom, thing took off. And I think it's only the beginning for what we're going to see from on-chain futures. So here's one thing I'd say, is I think synthetic assets still feel to me very, very underexplored. So obviously we have synthetics, which like right now is still pretty tiny trading volume, like it's not really working. Mirror is the other big one. And then UMA is the third. None of them are really working at scale. Like there's not, like one thing that we know from the very beginning, like back when I first was getting into crypto investing, one of the things I was like absolutely positive of is that stablecoins are going to grow like fucking crazy, because we don't need to convince ourselves of anything. We don't need any fancy thesis. We know that demand for dollars in the world is huge. And there are a lot of people in the world who can't get dollars, and crypto makes it really insanely easy, right? So it's no wonder that stablecoins have absolutely ballooned over the last couple of years, even in non-crypto use cases, right? The second thing that I feel like is the corollary to that is that getting synthetic access to any asset just by having an oracle as an input, right? Like being able to buy, Tesla stock or, the S&P 500 or any financial asset that anybody could want in the world, right? That is something that absolutely is going to take off. It's going to be fucking huge. And right now it's tiny. Right now people don't really want it. Why don't they want it? Because most people in crypto are
crypto speculators, right? They're not people trying to diversify their 401ks by getting into Ethereum or Avalanche or whatever. But eventually there will be. And those people, like, I think about my grandmother. Like, my grandmother lives in Pakistan, and, like, my grandmother's super old school. She was, putting money in a chest under her mattress, usually in gold, because she didn't trust the rupee, because the rupee has gone through all this, crazy inflation and government changes and stuff. And, like, why doesn't my grandmother and all the, hundreds of millions of people like her, why aren't they saving the way that you and I save? Or maybe not you and I, but, like, I don't know, whatever, normal people. The answer is not that she's dumb or, like, she doesn't understand that, like, okay, investing in a diversified portfolio of stocks and bonds or whatever is better, is that she doesn't have access to those things, right? And, like, someday you will be able to just take a mobile phone and buy any asset you want. That, to me, is so fucking obvious that it's going to happen.
And huge.
The same way that it was obvious to me that stablecoins are going to grow like crazy, but it hasn't happened yet.
I like the idea that your grandma's neighbor has just watched this and gone, she's got gold under bed. All right, she goes out at 3.
Grandma's neighbor is probably not watching Up Only TV, but maybe you guys have
Never
bigger
know,
reach
never
in
know.
Pakistan than I know.
Both Cobie and I have now been
You check
recognized in
those
public.
numbers. You check those numbers.
Yeah.
Yeah, that is that. I think that is true, and because in crypto there are such great returns, focusing on crypto stuff, all the, like, synth stuff feels a bit like boring or vanilla. So why would I buy Apple and get, like, 0.2%? I saw Romano the other day, like, did a weird trade where it was like he was trading the Tesla versus Apple pair, and I was like, like, what on earth, what has happened in your life? Why you've ended up here? But he does very well, so fair play to him. But then there's also a bunch of, like, like Gensler hates it, don't like the synth asset stuff, and there was rumors that someone got SEC served at mainnet who was operates one of these things. So
That's right.
So I do think it's a really interesting space, and I think it'll be interesting to see how it plays out.
To be clear, it definitely can't be offered to U.S. users, which, like, who cares, right? Like, why would you want to offer this to U.S. users? They can already buy it in their Schwab account. Like, why would anybody in the U.S. ever need it? The whole story about crypto has always been a global story, right? It's about global permissionless financial flows and access to the same things that you and I have access to, right? Like, it's almost, crypto to me is very similar to, like, what Amazon did for retail. Like, Amazon, if you live in New York City or if you live in SF, right, then Amazon wasn't that big of a deal because you can already go walk down, a couple blocks and, like, buy anything you fucking want, right? But if you live in, like, Wyoming, then Amazon absolutely changed your life because it allowed you to buy anything that somebody in New York or San Francisco or Boston could buy just by walking down the street, right? It brought that universe of commerce to everybody in the world, or sorry, everybody in the US, or where they're served by e-commerce. Crypto does the same thing. DeFi does the same thing. That, I believe, is the fundamental story behind DeFi, is that it gives access to people who wouldn't otherwise have access to the same degree of financial services.
I would like to talk about DeFi a little bit, actually, because ETH DeFi in particular has been just I think if you bought the core of ETH DeFi a year ago, you've lost like 70% of your investment in ETH denominated terms. It just feels like it's been in a bear market since DeFi summer, not this summer, the previous summer, again, in ETH terms. Start of the year, obviously you had, Jan, Feb, you had, like, really big pumps, but a lot of them didn't even make new all-time high in ETH terms, did they? It was maybe Arv did, but I don't really remember. What do you think is playing out there? Do you think, I thought about this a little bit, not too extensively, because I try not to, brain's fragile, but I thought about it a little bit, and, like, maybe it's that ETH scaling issues means retail can't ape very well on ETH. Maybe just better ways to allocate capital. Maybe people are waiting to see what the dominant winning, like, chain is for DeFi stuff, or maybe NFTs just simpler to people. I like the pictures. I'm in it for the art.
I think it's probably a mix of all those things. It's pretty clear that most consumers, you ask them, like, hey, do you want to use an on-chain money market? It's like, what? I don't even know what a regular market is. You know, like
No, I want a picture of a penguin.
yeah, exactly. Like, do you want to buy things that might make you 10 times your money in 3 days? Like, yeah, I want to do that. So the question is like how you get consumers on board and how you get like really fast growth. Very, very clear that NFTs are much more consumer focused than DeFi. DeFi is going through a lot of scaling issues, obviously, but also DeFi hasn't really evolved that much in the last year. Like some things have, like Uniswap 3, and there's some innovations now around fixed term lending, or sorry, not fixed rate lending, and other primitives that people are building. And of course, derivatives are taking off with the advent of DYDX, and perp is also growing a lot, and I think there's probably going to be more growth there in the near future. But by and large, the kind of core DeFi primitives of spot trading and then money markets and lending, they haven't grown that much in the time since DeFi Summer took off. And I think a lot of that is just due to the fact that, like, look, what's bringing new people in? Most of the stuff you can do right now is get yield on crypto assets. And like the honest reality is that like there aren't that many people who are technical enough and who understand the custody model enough, like to really keep growing that pie. You need to get another layer, whether it be wallets or gaming or something else, that actually gives people the front end that makes them, something like Coin98 is a good example. Coin98, big wallet in Southeast Asia, got a ton of people into crypto for the first time and got them to start using a lot of these primitives. You need a lot more things like that. And part of that is also gated by regulation, right? Like wallets, because they are consumer facing, they're an easier nexus for regulation. They move slower than the DeFi protocols themselves can move. DeFi protocols can just keep innovating, even if not that many people are using them. So that's ultimately the advantage, right? All the stuff that we're seeing in DeFi, most of it was built before anyone gave a shit.
Yeah.
Most of the stuff was built in 2017, 2018, 2019, when, it was like, we were celebrating at like 100 million TVL in DeFi. Like everything felt like a toy, nothing felt real. And like now you have these crazy amounts of money in these protocols that like don't really do anything. So we've gotten kind of, numb to that. But this is the way that innovation looks. People build a bunch of stuff, nobody cares for a while until they find a breakthrough, and then it opens a new layer of users.
I feel like there's a lot
Outside of after you, mate.
Well, there's a lot of money that'll still be deposited in DeFi, but I don't know like the percentage of people that will care. My business partner.
Yeah, active addresses for Arbs, like 40,000 addresses or something.
My business partner was sitting next to somebody on a plane from traditional finance and started talking, and the guy mentioned that 7.3 billion out of 7.5 billion people in the world live month to month and just don't give a crap about like interest rates or yield. But they definitely like a higher percentage of people than that are going to care about like, I don't know, maybe collecting something as an heirloom or a game or something fun or number go up technology that's not necessarily like 6% APY on your dollars,
Yeah.
So like maybe the DeFi footprint of what's interesting is really only interesting for people with like a handful of people with a whole lot of capital.
But here's the thing though, sorry, go ahead, Cobie.
I was just going to say, it's funny, innit? There's like people who are like living month to month who are more likely to buy sheep than to like, I could earn 25% of my money this year, or I could buy dog token. They're definitely doing the dog one, aren't they? They are. And they're making more money than me. So fuck them.
That's why lotteries are popular, sadly. Like
That's right. Well, but so here's the thing that a lot of times when we think about crypto, we think of it, when we think about crypto adoption, and we think about like the growth curve of crypto, we think of it like the internet, or we think of it like mobile, or we think of it like gaming, right? And most of these things that we're kind of intuitively comparing it to are things that are extremely mass market and that are relatively low ARPU. ARPU means average revenue per user, right? So what I mean by that is like if you get the marginal person on social media from India or from the US or whatever, right? You're probably making less than $100 for that person. You're not making that much money, right? And the way that you make a lot of money is by going very, very broad, getting billions of people onto your platform and then charging each of them a small amount of money and like basically free. Right? Like that's kind of how Facebook and a lot of these platforms work. And if you're thinking of that economic model, then you're thinking like, okay, we really need to get hundreds of millions of users, and until we get there, crypto is not really going to achieve its potential. But to your point, Ledger, you were saying that vast majority of people in the world are living month to month and don't really have complex financial needs, right? If that's true, then you should really be thinking about crypto more, again, like a power law, because finance and money is power law distributed. If it's power law distributed, that means that a small portion of people have almost all the money, which is one of the reasons why people are lamenting about income inequality. But it's broadly true in the world, not just in the US. It's broadly true just generally about money. So what that means is that a relatively small number of people drive most of the money. And you need to get those people, not the 5 billion people who have generally not very much interest in financial primitives, right? So if I tell you that I'm the CEO of a bank and my bank has 100 customers, that actually doesn't tell you very much about how big my bank is. Depends on who those 100 customers are, right? 100 customers, if I'm like a credit union in Iowa, then maybe I'm a tiny bank. But if I'm like a bank in New York City and my customers are like a bunch of other super rich financial institutions, then I might be an enormous bank. That's the way that crypto works. Crypto is more like a bank than it is like an internet company. And as a result, DeFi might never get that big in terms of the number of users, but it might get really fucking big in terms of the net value of all the money that's flowing through it.
Have you seen much stuff coming up that does innovate on? You said it hasn't changed too much since DeFi summer. Have you seen many things that you're interested in investing in, either personally or professionally, that you think does change the game a little bit? Because like derivatives has been one of those that's sort of started to catch on over the last year, like half a year or whatever. Is there anything coming up where you're excited about it? It's like the DeFi 2.0 or whatever?
Well, so I'm really excited about a project that's launching soon called DerivatiX. They're similar to DYDX, except in DYDX, the one wrinkle with DYDX, so obviously they're built on Starkware, but the order book is run by the DYDX team. Mm-hmm. So they run just a server, and if the server goes down, which like it went down a little while ago, then the whole exchange is down, right? And DerivatiX, they're a protocol that what they do is they're building an exchange that runs entirely within Intel SGX. So Intel SGX, any chance you guys are familiar with the term SGX or like trusted hardware? Trusted execution environments?
Let's say no, because our viewers, I'm doing it for the viewers. I know personally,
obviously,
I'm an expert actually. I'm an expert, but for the viewers' sake, let's say no.
Tell me.
So Cobie, you can take a step while I'm explaining to the viewers. So trusted hardware is basically this idea that if you have a normal computer, right, like the laptop that I'm currently calling in on, if you have a normal computer, your computer just like runs instructions, and like if I tell you my computer ran this program, you just have to believe me. There's no way that you can prove in principle that this computer ran this program. You can say like, look, I calculated the sum of like all of the addresses on Ethereum, and here's the number. The only way you can know that's true is by checking it yourself. Okay. What trusted hardware does is it basically it enforces at the hardware layer that you know exactly what code a computer is running, and you don't have to trust somebody who just claims a computer is running a certain kind of software. Okay, so one example of this is actually your ledger, like your physical ledger. You guys use ledgers? Like ledgers include trusted hardware, a trusted execution environment that will only let it run certain software. Basically meaning that you can know that like nobody phished your ledger. Nobody like managed to convince you to install some software that like doesn't belong to that ledger. The ledger only runs certain software that's been signed by a certain party, which is ledger core. So many modern computers have this notion. If it's built by Intel, it's called Intel SGX. And there's another network that we invest in called Oasis that like does this as the underlying layer for a layer 1 blockchain. What DerivatiX does is it runs the exchange on Intel SGX itself. So that means that you can have a really fast order book that's as fast as running it on a regular computer. It's not like run on the blockchain, but it's run in trusted hardware. So you don't have to trust the operator of the exchange that they're doing anything finicky. And in order to make it decentralized, basically like every so often, you can imagine like every night at midnight, the person who's running the exchange on their SGX, so let's say you're operating the exchange, you're running it on your SGX, you cannot fuck with the exchange. You can't actually do anything with it. You can't be like, oh, it's my computer, so I'm gonna mess with it. Intel SGX will not let you at the hardware layer. So if you're running it on your computer today, tomorrow, let's imagine every night at midnight, you like baton pass it on to somebody else. And the next day they're running the exchange. And the day after that, someone else is running the exchange. And it just keeps kind of round robining, passing over and over and over again, so that it's getting you centralized performance, but still being totally decentralized and still being totally trustless. That architecture, I think, is absolutely what's going to revolutionize, exchanges. And DerivaTech is working on it. They're slated to launch it, so that's one I'm excited about.
That was a good refresher for me. Good,
It's always good every so often.
But an important question that has arisen from the chat is when airdrop?
Good question. I do not know when airdrop.
That's the real alpha for this show.
Yeah.
We
I
are
couldn't tell you, but follow their Twitter, and I'm sure there will be a notice.
We're running a little over time. I know you have a schedule. Haseeb. I do. I want to ask super quick. You talked about your bullishness on stablecoins. Do you think that we're going to have a world where the dominant stablecoin would either be non-dollar backed, so like a basket of goods relative value, or algorithmic rather than the USDC, USDTs of the world? Do you think that's a likely future or a possible future or a no chance in hell?
I think it is a possible future with the basis of regulation. I think if regulation comes in, and it's obviously going to happen, like there's going to be some regulatory framework. The real question is, in the regulatory framework that's coming, are non-KYC users going to be allowed to hold arbitrary amounts of the stablecoin? That's the real question. And if we see laws get drafted basically the way that we're kind of expecting them to get drafted, like as a sort of status quo that Treasury wants or that Biden wants, then the answer is going to be no. And that is going to fuck the entire global crypto trading market because it's all dollar denominated. So if that happens, people are going to have to find a decentralized alternative or an offshore alternative, right? So it could be that it's like, okay, well, Tether is going to just keep running away. I don't think it's going to last that long if they really try to keep on the run. So ultimately, if that happens, and I suspect it eventually will, there will be a bifurcation between the onshore crypto market, which is going to be dollar denominated, which not that many people really care about stablecoins in the US. Like, why would you? You have actual dollars. It's mostly internationally where stablecoins are so valuable. They allow places to dollarize. They also allow people to denominate their financial activity in dollars. And there you may end up having to use DAI or Frax or some other type of US-backed stablecoin, USD-backed stablecoin. Or if, let's say, it becomes untenable to even do that, you may end up moving into something like RAI, which you guys familiar with RAI? It's like it's not backed to $1, but it's like a stable-ish token, where it right now it seems to be trading like around $3, and that seems to be where it's. Yeah.
That was not my bags, but it's a bag. Like somebody else's.
It's someone's bag. It's someone's bag. It's not my bag either.
I really like RAI. RAI's very cool.
RAI is very cool. Yeah, I totally agree. Very big fan of RAI.
I'd love the experimental nature of that, even though I feel like it would be very dangerous towards the cycle itself. Anyway. All right, sorry.
Yeah. I can't believe we've been going for 2 hours, 10 minutes. It feels like we've been talking nonstop. But also
we're obliterating whoever his next less important meeting is. Like we're just obliterating their schedule. So. All
right. Have you got anything else, Ledger? We'll wrap it up since we're 2 hours, 10 minutes. I think have we ever been over 2 hours before?
Yeah, we have once, maybe twice. We're good. We nailed it.
There you go.
I feel like we did it.
All right. So we ask our guests the same final question every single time. Originally it was basically how can our audience get rich, but often people don't really want to answer that question because puts a lot of pressure on them, and our audience, if I'm being totally honest, they're not that bright, so they're gonna misinterpret what you're saying, fuck it up, then blame you.
And you already said
I love the abusive relationship you guys have with your audience.
Yeah.
Well, we they can't afford the advice. So it has evolved perhaps into something a bit less tangible and more perhaps philosophical, and instead a piece of advice or a life lesson maybe that you find yourself reflecting back on throughout your life, something that's helped you. Maybe you heard it in a song, maybe a high school teacher told you it, or maybe you were reading some old romantic author or something, or maybe it was Mark Cuban in an episode of Dragon's Den. Oh, you call it Shark Tank in America, don't you? Shark Tank. And you were you know what, he's smart. It's called Dragon's Den in the UK. Yeah,
Dragon's Den. Wow.
Yeah,
that's so okay, sorry, go on.
Yeah. But just something that you go, that was really useful, and it's some kind of maybe a mantra or something. I always reflect back on it, and I've always found it useful, and it'll be on my gravestone, or pass it on to a future generation somehow in my life, but now you get to do it on this podcast.
Yeah. Okay. As you were describing this for me and explaining to me how strange words you guys use for things in Australia, I was thinking. Wait, are you? Wait, is that not what you're saying in Australia?
Cobie, you gotta do it in Australia.
I'm sorry. You're British.
Yeah, same thing. It's the same thing. Don't worry.
Same thing.
Look, it's the same thing. Australia just loads of criminals from Britain that got shipped off.
That's right.
Sorry. I had a
deserves to be in
brain fart for a second.
Australia.
I think it was your hair. That maybe for some reason it was like, oh, dude, this guy is from Australia.
Love it.
My bad. That was really dumb.
Good. It's perfect.
All right, that's a great note to end on.
Alpha.
So clearly how incompetent I am at giving any kind of advice. The thing I was going to say is, I mentioned it earlier, but I think it's probably the one big takeaway is that, like, in crypto, it's really easy to overthink things, and the obvious thing is usually right.
God, that's good.
There you go. Nice and simple. Ledger?
Yeah.
That's
Thanks so
not
much
a
for that,
knife.
mate.
This is a knife. I think. Go to uponly.tv/FTX. Thanks for being here. Follow Haseeb Qureshi at Dragonfly Capital. That is dcp.capital. We'll catch you next time. uponly.tv/FTX. Make a trade, track your portfolio, earn yield, do all those things at uponly.tv/FTX. Talk to you next time. Bye-bye.
Thanks so much for coming on, mate. Thank you. Love you, Ledger. Bye.
Amazing.